Good morning, everybody. What is going on, friends? Hope you guys are having a great morning. It is very early right now. We are up for one main reason. No, not because it's my birthday. We are up this early because Oscar Health just reported earnings. They came in with a double miss, which isn't so great. I know. But when we get into the numbers here, you are going to freak out on what they are guiding for 2026. I'm joined by my good friend, AC Investing, who's been covering Oscar pretty much like a madman. He's been over everything. He's been over all of the politics, all of the voting, all of the just everything on this company. This guy is on top of. I'm so happy to have him here. AC, how you doing?
I'm doing good, man. Happy birthday, dude. It's
I
a good morning.
appreciate it.
It's a
I
good morning in the
appreciate it.
Oscar world today.
Yeah. Let's get straight into the numbers. I'll pull it up over here on the screen. What are your first knee-jerk reactions for the people?
So the first thing I did was the opposite of probably everybody in the retail community is I didn't look at the stock price. I just pulled up their earnings report. And the first headline I see, which completely smashed every expectation I had out of the park, was achieves record membership of roughly 3.4 million, which is what is that, a 70% member growth year over year? That is absolutely insane, right in the headline off the bat. And forecasting over 18 billion in revenue. That is just absolutely insane.
Yeah, I mean, that's what I saw. Not gonna lie, I rolled out of bed and yeah, I just clicked on Trading View and I was like, I wonder what they're doing. They're like down 1%. And then I
Yeah.
came downstairs and pulled this up and I was like, that was the first thing I read. I was like, achieves record membership of 3.4 million, provides full year 26 guidance, including more than 18 billion in revenue. So absolutely insane. The next thing I went towards was medical loss ratios. I was like, what are these medical loss ratios? Because if you guys don't know, medical loss ratios is kind of like the biggest dictator of margins for these health insurance companies. It is going to tell you exactly like what we can expect for the margins going forward. So if you have been following Oscar, if you've been with us with Oscar, you understand that in 2025, we were slotted to be net profitable. We were slotted for sunny days, no issues, but across the board in the health insurance world, medical loss ratios, MLRs, just absolutely skyrocketed away from the mean. The mean is 80. Okay. The mean is 80. We skyrocketed to, you can see right here, 95.4. And this isn't just an Oscar issue. This was an issue across the board for all health insurance companies. Everybody was getting rocked by these. But the thing about the mean is the mean always reverts back, right? It wouldn't be the mean if it didn't revert back at some point. So first thing I did after I saw this, right, was like, what are the medical loss ratios? And we see that they've dropped, right? They dropped down to 87.4. But for this 3-month quarter, it was 95.4. So I don't know about you, but I really don't see medical loss ratios staying this elevated or continuing to increase into this year, 2026.
Yep, definitely for sure. And across the board too, pulling up the MLRs for pretty much all the major insurance companies. The only one that had a higher MLR from a 2025 standpoint, we have Oscar at a full year 87.4. And then following that is going to be, I believe, Cigna at 84.55. And following that, everybody across the board is higher than Oscar by quite considerably, at least 1%. Even UNH was at an 89.13. Another big one, Molina, 91.7, CVS 90. Cigna and Oscar are two of the lowest in terms of MLR for full year 2025. So just paying attention from an MLR standpoint, one of the most important metrics when we get into an insurance company like this. Even though the full year MLR isn't the greatest, Q1 really set the standard and brought that overall full year down, with coming in at 75.4 in Q1 2025. So when it does come to the insurance industry, when you're doing those annual price increases, right back in Q1 of the following year, pretty much every year is a price reset. So Q1 2026, we're definitely going to be seeing a pretty low MLR, and that pretty much brings down that full year average. So MLR is definitely very important here.
Yeah, and two things with that, right? So they are pricing in for 2026. They priced in premiums to cover this current high elevated MLR ratio, right? So let's just say that they priced it for these higher MLR ratios. Let's just say it goes down in 2026, which it should. Then they priced it this premium, but they only have to pay this MLR. Now, all of that between there isn't just margins, by the way, because health insurance has a lot of rules and regulations around it. So it's not like if they charge $1,000 and it only costs $100, then Oscar pockets $900. That's not how it works. But it does mean that the margins would be very, very juicy, right? It's just they're not going to keep all of it. Okay, they have to give some back. They have to write checks back to their people, back to their users. But if you understand fundamental analysis, if you understand investing at even the simplest of levels, you understand that when a company is decreasing the money that they spend on employees, on toilet paper, on whatever it may be, you understand when a company gets really, really defined with how much money they're spending and they're decreasing it quarter over quarter, year over year, they should be going up in margins. They should be getting better margins. That is the case for most companies, but obviously with health insurance companies, medical loss ratios play a big, big role in this. But I'll point your attention to this. When medical loss ratios come down, you were looking at a company that is only getting leaner. 19.1% SG&A expense ratio. So these are their costs, right? General and accounting expenses, right? And then you set 19.1 down to 17.5, 19.5 down to 18.2. So on a quarter over quarter basis, year over year, right? They continue to bring these down, guys. And this is massive. And you can see it right here in the numbers, right? So 87.4 medical loss ratio versus 82. Well, that means that instead of 57 million, right, in gain, they lost. Instead of this in gain, they lost. And then even though they made more revenue. Same thing here for the month or the quarter over quarter, more revenue, but because of such a high medical loss ratio, but even though they had lower expenses, they lost more. Again, it all comes down to those medical loss ratios. So if you look at Oscar, and AC will probably agree with me on this, if you look at Oscar, everybody wants to crap on the company and everybody wants to be like, oh man, they double missed today, like that's terrible, blah, blah, blah. But you really need to just understand that they don't have any control over the medical loss ratios. That's just the hand that we're dealt as shareholders in this company. But if you understand this company and you understand where they're going and you understand just even that the mean is 80% medical loss ratio, and it's a mean for a reason. A mean means average. Like this is the average, 80% average over the past forever. I don't even know, right? But when we come back to the mean, that means that what they're doing here with revenues exploding, what they're doing here with SG&A costs coming down, guys, you're looking at a company that's going to have some like very, very nice margins, very, very nice net income, EPS, better free cash flow. I mean, correct me if I'm wrong, AC, right? I mean,
I was even going to say, just in terms of 2026 guidance, someone also had mentioned this is all without ACA subsidies. And this is kind of where I lose some people in terms of the ACA subsidy talks. But, putting our tinfoil hats on a little bit, what we saw with, for example, most specifically, Centene. Centene, what they did was they raised their prices by roughly 35%. And they didn't advertise that they specifically exited the ACA marketplace, but what they did was they made their prices pretty much higher than almost everybody across the board. A 35% price increase, I believe when I did a quick check, was roughly $100 more than a plan than Oscar. So when we're talking about all these companies, they pretty much said, we don't care about the ACA marketplace. We're just going to only care about profitability. And now that they only care about profitability, they raised their prices too high because everything in the ACA marketplace is all about pricing. This is going to force everybody to Oscar. And Centene saw roughly a 40% decrease, I believe, in members, like drastic, from 5.1 million to 3.5. And that was mainly fueled by them exiting, but not exiting the markets. Because what Oscar's doing is they're continuing to expand. Because in the 2026 open enrollment period, they saw roughly 14% increase in coverage across the board, coming from a county and state level. So when we do go into 2026, all of these companies have already lost their market share to Oscar, and we're seeing that pretty consistent within the actual earnings report. We're seeing over 3.4 million, roughly 3.4 million members, and imagine if ACA subsidies were to be extended. We're guiding at 18 to 19 billion. And realistically, the only pathway to the ACA subsidies actually going through right now is midterms. And we kind of saw this with the government shutdown. And I definitely try not to get political any more than I really have to, besides stating the facts. But when it came to the government shutdown, the ACA subsidies was one of the big reason that the government shut down in the first place. And then when we actually got to the end of it, everybody's kind of like, okay, we'll just get something passed. We'll work on it. And it was more so we aren't passing it because we are going to use this for political theater. So when we go down the road closer to midterms and more so likely to actually get something passed because we're like, hey, this is no longer political theater. We're actually going to work on something because there is a relatively decent proposal out there. If we do see an ACA subsidy extension, this is only the beginning, and we could probably see one, much more consistent revenue and I guess credible revenue in 2026, because even though the revenue numbers are very strong, if we do end up seeing some sort of drop off, at the end of the day, the ACA subsidies will only further strengthen this, and it will also probably extend the open enrollment period depending on when it is done in 2026. But if it's not done in 2026, going into 2027 or something like that, it would only further fuel their growth. But at the same time, the ACA subsidies are not necessary for Oscar, and it is very clear through this earnings that ACA subsidies are only a plus, and the other larger legacy insurance companies, they need ACA subsidies. They're seeing huge drops in their members, and they just aren't able to actually compete. And this is what Oscar is doing. And with their SG&A expense ratio, for example, as this further goes down over the years to levels like some of the other companies. And by the way, Oscar is still in their growth stage. They're still in their growth stage, which is very evident through this earnings. And they're also still building up their infrastructure still, which they've spent over a decade doing. And it is absolutely incredible what they're doing.
Yeah. And AC, I mean, come on, we could call this, we could be real here, okay? Look, they're going from almost 12 billion revenue to going to 18.7 to almost 19 billion in revenue. Massive jump. So yeah, they're definitely still in a growth stage here, almost doubling their revenue year over year. Not only that, right? Well, I was talking about these medical loss ratios earlier, right? I was sitting there saying, okay, look, the mean is 80. In 2024, we were doing 82. And this is when everybody was like really noticing Oscar, and like they're sitting there like, oh, well, this company has earnings and net income and blah, 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 right? Great. And then it obviously started to deteriorate because medical loss ratios were climbing, right? Look at this. They're guiding. This is their full year 2026 guide, by the way, guys. 18.7 to 19 billion, which is just like, it's massive. Massive, guys. Again, they're doing 11.7 billion for 2025. That's the end of the year. 11.7 billion. Now jumping to 18.7, 19 billion. Given, I'm not just going to say that number and like not add context to it. The context is, okay, hey, they're charging more for premiums. Everybody's charging more for premiums. That's what this whole thing has been about. This premium spike, because of no more ACA subsidies, things cost more now. But like AC's been reporting, and like we've been seeing, their membership drop off has not been what everybody has been thinking it was. There's not this like huge drop off cliff. Okay, we're looking at probably less than 10%. Would you say, AC?
Dude,
in the numbers?
Are you talking? Do you mean overall marketplace or?
Yeah, overall marketplace.
Overall marketplace, it's very interesting because from the year-over-year data from the snapshot, we're at down roughly 4.94%. And what is very, very crazy is that when we're looking at these other competitor companies, is that Oscar saw a very large surge in their actual member count. But when we're looking at all of these other companies, for example, UNH is expected to lose about like 2/3 of their market share within the ACA marketplace. I mean, they're going from, I'm not sure their exact numbers, but they were owning a pretty large amount of the ACA marketplace, and they're going down like 66%. And this is mainly off of them just flat out exiting the market. And it was very hard this entire time to sit here and go on YouTube and go on X and be like, all of these other insurance companies are losing a crap ton of their market share, but Oscar is different. Like it kind of becomes a little hard to say that because a lot of people just straight up don't believe you until you show them the facts, the search trends, just everything across the board was showing that Oscar was going to have an incredible 2026 guidance. And that's where we ended up seeing what we ended up seeing. And, off of that initial just drop, people probably just flat out with the algos looked at the actual quarterly earnings, dropped the stock, and then are like, holy crap, this guidance is insane. And we just recovered from that.
Yeah, knee-jerk reaction was double miss. This company's trash like I thought it was. Everybody's initial reaction. Yeah. But then if anybody has half a brain, they look at this massive revenue growth, 18.7 to 19 billion revenue guide for 2026. That's not even like this. To me, it's whatever. What really matters to me is that, look at this, right? 19.1 to 17.5, 19.5 to 18.2. That's SG&A expense ratio. So they're guiding for between 15.8 to 16.3. So they're going to drop it another like point or two. They're going to drop it another full point or two on the SG&A expense. Not just that, but the medical loss ratios they're guiding for are going from 87.4 for the full year down to 82.4 to 83.4. Guys, when we were at 81.7, look at this revenue. Or sorry, look at this net income that they were able to pull. So now they're guiding for lower medical loss ratios. They believe it's going to come down. And if it comes down with this type of revenue, guys, this is essentially saying 250 to 450 million earnings from operation. That's like 2.3% margins. That's 2.3% net margins on this revenue. That means they go back to EPS positive, net income positive. That means people start talking about Oscar again, like, and they really understand, like, at these levels, at $13.65, at around a $3 billion market cap, when they have $1.5 billion in cash. Yeah, you heard that right. $1.5 billion in cash and a $3 billion market cap. Oh, they just did $777 million in free cash flow as well on a trailing 12-month basis. Yet it's a $3 billion market cap, guys. What were you saying, AC?
I was going to say what's even crazier is that the mean 2026 revenue forecast was 12.8 billion. Those analysts were so wrong. It's not even funny. And even
Yeah.
back when in November 2025, Piper Sandler, which is a more credible, a credible analyst within the kind of healthcare industry, they were expecting 404 million in 2027 adjusted EBITDA as the floor. And let's just say there's a very good chance that they are correct. And when it does come to, you know, when it does come to the overall member growth, nobody was expecting this to be seen, and that's why a lot of these price targets were conservative. You know, yeah, we saw some pretty not too great revenue targets. Yeah, 12.02, 12.76, 14, and then 15. Dude,
They're doing more revenue than they were guiding than analysts thought they would do in 2028. Again,
yeah,
again, we have to give them their flowers as well if we're gonna crap on them because look, premiums have skyrocketed. I will say that. But we can only give them their flowers so much, AC, because how long have we known that these premiums were gonna spike?
very
We've
long
known
time.
for months now, and they already have been spiking. These analysts, these nine analysts right here. Look, analysts aren't great, okay? Analysts aren't great. They got a ton of companies they're covering. They don't stay too much up to date with them clearly because if they were, they would have came in here and maybe, fixed up these numbers. Because there's no way you think they grow, 12.76 billion in revenue for 2026 when premiums are skyrocketing, unless they literally just thought that the memberships were just going to die, which
Yeah,
they didn't.
I mean, these numbers, especially once again, circling back to the ACA extension, kind of like what Pat had mentioned in the comments, if politics align again, dude, everything changes, and we could see like another pretty similar year going into like 2027. Now, 2026 is the kind of the year where they kind of help build their baseline. They kind of help build their baseline and kind of really take market share. So going into like 2027, for example, from a member growth perspective, we might not see them without the ACA subsidies, but going into 2027, if we got the ACA subsidies, we could see another huge, massive member growth year. And a lot of these companies, if the ACA subsidies are extended, they're going to want to take back their market share, which realistically they probably and most likely have already lost just by exiting the market, and they've very evidently lost it to Oscar.
Yeah, I mean, so wait, so you don't think they're going to continue to grow memberships without ACA subsidies in 2027?
I do, but I just don't think that they would grow them, 70%, for example, or
Oh yeah, they're not going to grow them
50%.
like this.
That
No.
wouldn't happen, yeah. But, if we want to see like a lot of people focus on, like these tech stocks and all of that, having these insane growth. And for an insurance company and insure tech company, this is just insane growth. Especially for a company, this size and for this market share, going from 2.1 million members to over 3 million, 3.4 million members, that is just absolutely insane growth.
Yeah.
And, I believe I just saw it, but like when it does come down to price increases, premiums on the, being raised, going back to that, was 28% weighted instead of centenes, which was, 35. And that is going to see a big difference because, comparing their average plans from centenes to, Oscar, I believe the average plan was higher by roughly $100. And for people in the ACA marketplace, that matters a lot. The people in the ACA marketplace, they tend to be on the, they're not exactly trying to spend the most amount of money. They want the best and best of the care for the best price. And I think a lot of these analysts and people were overlooking is that the baseline subsidies never went away. A lot of these people that are in the ACA marketplace, they're receiving up to their premiums are capped at up to 9.44% of their income based on the IRS guidelines. And there are still people out there that are paying pretty much nothing for health insurance just because of their income. And I think people were seriously kind of overlooking that. The enhanced subsidies definitely helped a ton, bringing down, some of those premiums very, very, very low for some of those more so on the higher income scale of that scale. But at the same time, if the ACA subsidies are extended, it's only going to prevent churn. It's going to increase members drastically for another year, most likely. And, as Oscar expands, which by the way, they are only in 20 states and I believe 573 counties. They still have, what is that, 32 states, and I don't even know how many counties, but there are a lot more counties for them to expand to. So it's only getting started for Oscar for sure.
Let's see if I can find it on here. Pretty sure it'll be on this one. Maybe not. Nope. Oh well. Yeah, like AC said, they're very small. They're only in a select few amount of states. They have a very, very large market to grow into. But they're doing it the right way, right? They're not like just going out there and just like, well, we're just gonna go in every single market. No, they're doing testing. They're making sure that they're gonna be able to do numbers in those new states that they want to move into. Another thing I wanted to talk about was, I mean, besides all this, let me talk to the chat. Appreciate all the happy birthdays, chat. Appreciate you guys. Hope you guys are all having a great morning. Let's go through some questions in here because we covered like kind of like the main stuff, right?
Yeah.
I mean, oh man, they're up 11% now. Wow. Yeah. Wow, $14. Which, guys, I know this is the funny thing about talking about Oscar, man, because like the people, I don't know about you, man, but maybe it's just me. People in my X comments really give it to me.
Yeah.
They're like,
Ronnie, this morning.
Yeah.
Dude, this morning after that, I think it was like a flash 11% drop, dude. I got hammered in my X comments. I didn't even look at the stock price.
It was a flash. Oh, right here.
I didn't even know that the stock was down a lot.
Man.
I found out in my comments. I was straight to the earnings report, and I'm like, holy crap, we're gonna be up like 20% today. This is just a complete blowout earnings. Yeah. And then I see my comments and we're like, we're down 11% AC. You failed us. What the heck is this? They were absolutely giving it to me. I'm like, dude, these earnings are insane, dude. We're like, realistically, like nothing here is like financial advice. But at this point, well, yeah, I'm seeing both to the upside and the downside. Now everybody's like, oh my gosh, like this is crazy. Like you were right. And so I'm getting both ends of it for sure. But, I think what people kind of overlook is that the amount of market share that was lost by these big insurance companies. Now, these are rough numbers from the top insurance companies in the ACA marketplace. But what is it? I think UNH is around 15 to 16%. And we need to understand that UNH was dropping their insurance coverage exiting by like 60, I believe around 2/3. They are planning to severely exit the ACA marketplace. And that opens so much opportunity for, companies like Oscar, for example. So if they're able to optimize costs across like the entire spectrum, they're only going to thrive and continue to thrive over these next few years. And with the leadership of Mark Bertolini, Mario Schlosser, and the rest of the Oscar team, dude, there is no way that Oscar doesn't become a very large insurance company at this rate. And also, they are only in the ACA marketplace right now. If they expand coverage out of the ACA marketplace and do so with the exact same efficiency as the ACA marketplace, this company has absolute endless potential, and we are only on the scratch of the surface.
Or they're really pushing into the ICHRA markets as well.
Exactly. Yeah.
Which, yeah, I think everybody's biggest misconception, and you probably hear this a lot too, is, look, I get the ACA subsidies thing. Like, I thought that was like a done sealed case. Like, I thought, because like as a human being, my like heart tells me like, hey, like we should extend ACA subsidies for at least 1 or 2 more years because we don't have a plan in place. So kind of like my heart and common sense was telling me like this should get done because it matters for the American people that struggle to pay for health insurance. Well, If you know one thing about the government, they will let you down, and they will make you question them very, very heavily. Okay, so um it could still happen because everybody keeps talking to me about it. Still ask me about ACA subsidies. Look, it can happen, but I'm honestly kind of like probably like AC. Like I'm kind of like done talking about it, like for like a lot of the time because I don't want that to be the only identity of Oscar. Like we talked about it just because like you need to understand that if they got extended, it was such a massive, massive thing. Like and like if they got extended, we're talking about Oscar like probably like $25 overnight. Like that's how massive it could have been.
Oh, big pop up. Was that like
Yeah.
30-cent candle right there too? Dude,
Yeah.
it's if the ACA subsidies were extended, we could probably have seen like it's actually very
Crazy move.
difficult this year because if the ACA subsidies were extended in stock price, we would have rose. But I honestly think if the ACA subsidies were extended this year, Oscar would not have had as strong member growth. And this is going to be a little bit controversial, but Oscar has taken so much market share from these legacy insurance companies that are much larger. They have taken a significant amount of the market share, and absolutely, absolutely, like right now, like someone had just mentioned, like, is this part of the plan? Because this very well could be part of the plan at this point to kind of see the effect of the ACA subsidies and inadvertently actually end up helping Oscar. Because once these big insurance companies lose market share, for example, UNH, Molina, just everybody across the board, now that they've already lost their market share in the ACA marketplace, there is absolutely no reason for them to actually gain those customers back once they experience Oscar's care. Oscar has much stronger care across the board. They have a lot of different, services. For example, Hello Meno, I believe is how you say it, which is their menopause plan, which is one of the I believe it's one of the only ones in the ACA marketplace, and that is going to be a huge attractor for women in the ACA marketplace. So that already, speaks volume to and, tries to attract that part of the market. And just having quality products and services and being able to ask their Oswell agent and just be like, hey, I'm having this issue. How can I help? How can I help this without going to the emergency room? Because getting more expensive care doesn't only impact the insurance company, but it also impacts the person that is being insured. If they're able to spend less on their own insurance care, it also helps the insurance company as well. Because a lot of these out-of-pocket premiums are quite expensive. And, for example, people in the healthier spectrum of the, overall insurance market, like for example, myself, I'm in a high deductible plan. My company, gives an HSA program. And instead of, paying for a lower deductible plan or a higher care plan because of my age category, because generally younger people tend to be on the healthier side, instead of having a more expensive plan, I'm able to save money there. And then anytime that I actually need care, then I can just go get the care for an overall cheaper price because I'm paying less on overall insurance premiums. And for when I do need care here and there, the insurance company saves money because I get less care. Uh, and overall, my plan for my situation is much more profitable from a insurance company perspective. So when we're seeing this in the ACA marketplace as well, where they're able to use their products and services to make their care cheaper, it only benefits Oscar, and especially going into 2026 and 2027, where there could be, there's a much larger risk pool. We're going from 2.1 million to 3.4 for Oscar specific risk pool. And if they really go through, use their virtual care products and all their other, care products, it's going to be a big difference for Oscar compared to the competitors. And even from a medical loss ratio perspective, we're already seeing that in the actual numbers, comparing it to a lot of competitors. Just going from the, medical loss situation, Cigna or CI is at 84.55 for the full year, and Oscar's at 87.4. And just having an overall lower MLR across the board than a lot of these insurance companies like UNH, which is around 89, just over 89. Molina was around 91.7. A lot of these insurance companies are not doing as well. And even for Centene was the one with the 35% price increase. They had to increase their prices. Their MLR for the full year was almost 91.2. And when we're looking at that compared to Oscar, Oscar didn't have to raise their MLR on a full year basis as much. And this is where they're able to really gain market share. At only 87.4 for the full year, that makes a huge difference across the board when you're having Centene. Hey, we have to up our prices to 35% because we have to take, we have to prevent risk. We have to be in a stronger position for profitability. And Centene had to increase prices more than Oscar because they were simply too cheap compared to the actual medical claims that were coming in. And it's just, Oscar is going to absolutely thrive and just kill it in this market. Someone said 7D inverse upside down, inside out, badminton, chess in space by Trump. Yeah, I mean, if the ACA subsidy extension does go through, then, this is going to be just an incredible next few years. Oh, Ronnie, I don't think we're able to hear you.
Oh, my bad. So what I was saying was, everybody gets mixed up that doesn't know this company in and out. They get mixed up because they hear ACA subsidies and they're like, oh, if ACA subsidies go away, they think ACA goes away. That's not what's happening here. ACA is its whole own market. Affordable Care Act is its whole own market, okay? So when ACA subsidies, if they don't get extended, right? Let's just say they don't. They still are going to thrive in the ICRA markets and ACA. And what are we seeing? How do we know they're going to thrive? Like AC was saying, they are stealing market share from the big dogs in the ACA markets. Okay, so they're stealing market share away from the big dogs in the ACA markets. They're expanding in the ICRA markets. Their revenues are exploding. Their medical loss ratios are some of the lowest in the health insurance industry. And they're just continuously bringing down their SG&A costs while, like AC pointed out, while they're hiring a ton of great people at this company. And you go over to their website and you see how seamless and simple this is. I don't have Oscar in my area, sadly, because this would have been a lot easier to do. But they make it very easy. You go here and you get everything you need, like $0 preventative care. Obviously, people want $0 preventative care. You want to go to the doctor and get a checkup, and you want to just you don't want to have to pay money every time you just go to the doctor for just something simple. Talks about condition plans, great providers nearby, and they use AI with all of this. This is the great thing. And then let's talk about your plan, right? And they just bronze plan, silver plan, gold plan. And it tells you lower premiums, higher out of pocket, moderate premium, and out of pocket expenses, and then higher premium and lower out of pocket expenses. Very simple, very upfront. This is why a lot of people really like that. With the other bigger players, it's more mundane. There's a bunch of BS with it. But anyways, guys, this free cash, or this God, my brain's just not there this morning. This guide is insane. I still can't get over it. This guide's insane. Let's go through some questions actually in the chat, because I've been ignoring them, sadly. But we had a lot to get to here. Let's see. Hoping for a pump. Well, you got it. 8.61% up. Yeah. The guidance for 2026 is really good, but everyone will doubt it if the earnings are this bad. I mean, they double miss, but
what I will say for that too is that 2026 is more so a reset year for the industry as a whole. These companies are increasing their prices because
even Mark
the morbidity. Yeah, the morbidity was not the morbidity in the broader market, just across every single insurance company, was not great going into the end of the year. So what these companies do from an insurance perspective, especially these last few years, because morbidity has been kind of on the rise, what they'll do is January will increase prices, and then eventually over time, eventually there's going to be a point where they raise their prices enough that everything stables, everything becomes stable. So in 2026, if we have a more stabilized MLR, the overall year-over-year inflation from the insurance premiums, we could see a much lower price increase going into 2027. And I think at the, going into the next level of this business, going into 2026 and already being in 2026, from a stock price perspective, we are getting incredibly, incredibly cheap. Like at this point, if we're guiding for 18, 19 billion, there's no reason for us to be at, 12, 13, even $14 a share at this point. And, nothing here is
$3 billion market cap.
at this point, it's far from financial advice, but what I'm going to say is that I'm just going to continue buying as much as I can in Oscar, and it's just going to be just a continuous just buy in my portfolio, and it's just going to stay that way.
Let's see. Double miss stock higher because of guidance. Once this market has digested the 2026 forecast, this is going to explode. That was at 658. Good job. Good job, Aaron. Aaron knows what he's talking about. Let's go. Says other AC.
Yeah.
Happy birthday. What's up, Ashton? From Ashton Invest. Other big Oscar bull.
Yep.
5% up. Great work, guys. Kudos to both of you. Appreciate it. AC, let's go. AC, you're doing great. You're doing a great job with covering Oscar. Thanks, man. Yes, he is. Christmas is over, brother.
Oh yeah, I forgot it. Yeah, I haven't had time to get my Christmas tree down. School's been a lot, and I covered.
Oh, I didn't even notice that. I just noticed that. He said Christmas is over. I was like, I was thinking like the deals for buying Oscar at these prices.
Yeah.
Great to be an Oscar shareholder. Yes, it is. Bunch of happy birthdays. I appreciate it, guys. Can we get straight to updated valuations? Yeah, we can do that. Look, AC's working so hard over there on Oscar, and he has his normal day job. Like he ain't got time to take down that dang Christmas tree. Okay, like he's doing God's work for the Oscar community. He can leave it up all year. I don't even care.
I work on I have an appointment today. I have a very, very important today.
Right. What is stopping the stock from trading at 2x NTM EV revenue? That's 10x from here. Am I dreaming? What am I missing here? So no, I don't think a 10x on Oscar's crazy at all, to be totally honest. I mean, when I run my projections, I don't know about UAC. I mean, with where they're going in 2026, it tells me a lot about, basically what they can do and where they can go. And I hate saying 10x, but that's since I've been in this company, since I ran projections, this is something that I've been thinking for a while. How long does it take? I don't know. But imagine we do 10x. Let's just talk about that. Imagine if we do 10x, and imagine how many times you got crapped on or I got crapped on for the stock round tripping from 20 to 11 to 20 to 14 to 15 to 27 or to 22 to 12 to, like we've round tripped so many times. I get it. But like long-term investors, we don't care about like, what happens in the short term. We care about where this company's going, and I want to be like, guys, the fundamentals, as long as the fundamentals stay the same, it doesn't really matter what happens to the stock price in the short term. Well, health insurance companies are a bit weird because like the fundamentals did take a big kick in the butt in 2025, but you just have to like understand why. And you have to understand the numbers behind it and do the medical loss ratios. You just have to understand the overall outlook of the company. Like memberships are still growing. They're not having this huge ACA like drop off cliff. Their SG&A costs are coming down. And then medical loss ratios, the mean's at 80%. So yeah, did they go net income negative? Did they lose money? Yeah. But like, it's not just an Oscar issue. It was a whole sector issue. So it's those things you just have to understand. So that's why we round trip so many times.
I was going to say too, there was something that someone had pointed out to me earlier this morning at like I don't know, when was it? Like 6:30 in the morning, which I woke up and I'm like, oh my gosh, earnings are already released. I like woke up and just like physically ran to my computer. I was like, holy crap. And like I saw the headline results of 3.4 million members and I'm like, I need to look into this. And something that was noted in here is the revolving credit facility. On February 26th, the company entered a 475 million secured 3-year revolving credit facility, which to my understanding is essentially just like a line of credit.
Yeah.
At this point, this isn't Oscar straight up increasing and taking a $475 million loan. This is Oscar taking proper risk management because they're growing really damn quick. Like this year was,
which is why they're hiring like crazy too, like we've been seeing.
Exactly, dude. We saw, I believe at the peak around 260 job postings. And there's a guy that was kind of feeding me some more info on this. And he's what is his name? A Rad Trading on X. And he basically one thing that he was pointing out is that, dude, these job postings, especially these more entry-level job postings, like the people that are like helping the onboarding process, working with the payment pricing, like there aren't just a single like role open for these positions. There are multiple positions open for them. And some of these roles most likely are being filled like 2, 3, 4, sometimes even 5 or 6 times. So when we're seeing those 260 job postings, it could very easily be closer to 350 to 400 job postings. And we just never saw that on like the frontline end. And, based on these earnings and in the 2026 guidance, especially from a member perspective, which by the way, what is very important is that the open enrollment period sets up everything for the future. It basically resets every single year following that open enrollment period. And there's, of course, going to be a little bit of change throughout the year, but most importantly, the 2026 enrollment period sets up everything for the future. And that's just something that is important to note.
Man, you were way off on your revenue guidance. I'm just kidding.
No. This is a screenshot.
Nobody expected what they were going to do.
That was a analyst projection because
really?
Were projecting that 12.8. Yeah.
I was like, dang, you did a nice little drop.
No. So my projections were all over the place because my overall thesis was they're going to grow significantly, but I just don't know how much. There are so many variables going on here. I basically said minimum of 14 to 14.5 billion. Absolute minimum. I don't see us growing less than that. And that's where I was at. And I was like, more so on like my internal group. I have a small group of a few people that are in Oscar. And basically like the overall projection was between 16 and 17. And for that number to be smacked out of the park, like I didn't want to advertise 16 and 17 billion because that number is definitely more so to be wrong. And I don't want to receive, too much crap when things go down. Like we saw this morning, I'm like, oh my gosh, at this rate, I'm receiving death threats by 11. And, you probably see a lot more of it, especially on the Oscar Zeta end with the market being down. But, I don't want to communicate something that would be more so to be incorrect. So, I just said minimum 14.5, and minimum 14.5 is just strong double-digit growth. And especially in a market like this, just proves that it would be more so a deep value play. But this is not just becoming more so a deep value play. It's becoming a deep value, like hyper growth phase in the ACA marketplace, because seeing this member growth in the ACA marketplace is very, very unheard of for a company like this. And especially for them to do this at such a sustainable level with even after a 28% price increase, which is weighted across the plans.
Yeah, people don't realize like they continue to steal market share in the ACA markets, right? And they keep growing there. Well, ICRA is just going to be gravy on top. Like ICRA is just going to be cherry on the top, like cherry on top of the sundae, because the margins in the ICRA markets are way better. Like there's way different rules and regulations and like pricing and everything in the ICRA markets as well. So like this, and people forget like me and AC are probably on the same boat. Like if Mark Bertolini wasn't in charge of this company, I wouldn't care about Oscar. Just to be totally honest. Mark Bertolini took Aetna Group, which was bought out by CVS, from like an infant to a mega healthcare player, mega health insurance player in the health insurance industry. And he knows numbers. He knows Wall Street because he was right next to Ray Dalio Bridgewater. So, you know, what you're getting here, it's crazy. And the guy like really cares about health insurance due to his own personal trials and tribulations with things that he's been through, like almost severed spine, and then his son overcoming cancer and almost passing away, and like all this stuff, all this. So his stories and his, like, if you listen to any of his podcasts or interviews with anybody, like his stories are absolutely profound. Like you have to just respect the guy. And there's one thing that stuck out for me since the beginning that I've said about Mark Bertolini. He's a man of his word. When he says things, he just doesn't just say them. He's not just like BSing people. Like when he says things, he means them. And like I know that sounds like, you know, oh yeah, I mean, but like legitimately. Like when he says he's going to do something, when he sits there and he says that in 2027 we're aiming for 4% margins and like, what do you say? He said like 14 or 15 billion in revenue at that time for
Dude,
2027.
April
But
2025 by 2027 was 14 billion and 5% margins.
yeah, which they already did that, and now they're at 2.3% margins.
Yeah.
So
But we're
how much
also
more to go? they already revenue check. You know,
Yeah.
that one was a little easier with premiums skyrocketing, but
Yeah.
you know, still, you know, it's really the margin. If they get to those margins, guys, like their EPS and their net income is going to be insane. We do have 7 minutes till the earnings call starts. Obviously, we're going to be listening to that together. We're not going to really be talking too much about that. We'll talk about all this stuff again afterwards, and we'll mainly focus on what is being said and some of the questions and some of the highlights that we see. And then we'll wrap it up probably, you know, before 9, I would say.
Yeah.
I
need to pull up your chat too, because I feel like you have a ton of good questions as well in there too.
Yeah, let's see. Is Oscar going to do a live earnings call? Yep. They'll do it here in 6 minutes. I got it pulled up and ready to go. Oh, trust me, no one's going to be talking about 2025 anymore. Lol. Anything concerning? The only thing concerning is the double miss.
Yeah.
But we already knew earnings weren't going to be there.
Yeah.
Didn't like how they missed revenue. Like I wish they could have beat revenue because they did guide for like 12 billion in revenue. So that did suck. But like at the end of the day, like their guide just like says, shut up. It's just like, shut up. We don't care about 2025 is over. 2026 is here. That's what their guide says. So, and that's clearly what, like, people just think like, oh, well, they missed. Like, guys, stocks don't move just because like they miss or they beat earnings, guys. It's all about the business. It's all about where the business is going. Tesla can miss and do terrible and they still skyrocket. They can do great and they could still plummet because it all depends on where the stock price has been. Right now, Oscar is at the bottom, well, was at the bottom of their consolidation point. They're at like basically liquidation value, guys, or they were. They still kind of are. It's crazy. This stock should be up like 20% today based on that guidance, because you're talking about net income coming in for this year, 2026, of 250 to 450 million, which is way higher than this 57 million that they did in 2024.
Yeah.
And like, I'm not even going to try to math that. Going from negative 396 million to 250 to 400, it's like a 1000% flip, basically. I don't even have to math that hard. A 1000% flip on net income. And same thing probably for EPS and stuff. So insane. Anything else you saw that was concerning?
I mean, I haven't gone like
Yeah, I haven't
deeply
gone.
into
Yeah,
the
me
earnings
neither.
call quite yet. But you know, definitely one concern that I have is that you know, with companies that grow this quickly in the insurance company, sometimes growing this drastically can almost be harmful. So that's kind of one thing that I really want to pay attention to. Um, because when we kind of look at this, you know, this goes back to a lot of other insurance companies that have, and I am far from saying Oscar would perform poorly, uh, far from that. But you know, I just want to continuously see strong executive leadership, especially from Mark and the team, to see this like sustainable and to be able to retain these members and just ensure that they have the workforce behind this. Because Oscar, one of their major products and services is that they have more personalized care and they have people in house to do a lot of certain tasks and to actually help with the care that they are kind of giving to their members and consumers. And with such a drastic increase in members, I just don't want to see the quality of care go downhill because that's not going to be good for the company long term. So that's something that I definitely worry about. But I do think they are really, really on top of their hiring. And just like the CFO said at the, I believe it was the UBS conference, is if we're going to, he basically said that if we weren't growing, you wouldn't see an increase in headcount, and we saw a drastic increase in headcount over 10%, just based off of what was posted on LinkedIn. And that doesn't include, for example, internal hires. Sometimes they hire internally and they don't post it to the public. Some of those roles are multiple roles. There might be a certain position more on the payment side or on the lower side that might be realistically 6 roles. They might have some of their personal care members that are, you know, there might be 6 or 7 roles, you know, maybe even more, that are just hidden within that one job listing. And that wasn't really shown, I guess, to the public as much. But you know, getting a roughly 10%, I believe it was roughly an 11% increase in job postings, that completely correlates with their operational efficiency as well as their actual member growth going into 2026. So I just hope that they're able to maintain that high quality of care in the ACA marketplace, because this was a definitely a significant increase in member growth. And I'm just kind of trying to think of a potential bear thesis, but you know, um, with it a big increase in members comes great responsibility for sure.
Love it. Love it. Um, yeah, this should be kicking off here soon. I got it in the background, so I'll pull it over once they get started.
Sweet.
We got like a minute. Yeah, I mean,
With this setup, I don't mean to cut you off, but with this
you're good.
setup, am I able to hear it as well, or?
Yeah, you'll be able to hear it as well.
Okay.
Yeah, I had to share the specific Chrome one because I tried doing this whole one over here, and it'll make you hear yourself too, and I don't want that. Yeah, everybody's talking about ACA subsidies, like, you know, if the Dems take back the House and so on and so forth. Yeah, guys, I say this. Just look at the numbers, look at what they're doing, look at what they're guiding for. This should be fair value, at least over a $20 stock, in my opinion, based on my fundamental knowledge of the company, at least. And they're sitting at $13.69, up 8% right now, up 7.5% now. If they get ACA subsidies, then you have this whole other like domino effect. They just started, so let me get this pulled up.
point. After the speaker's remarks, there will be a question and answer session.
Can you hear that, AC?
Today, we ask you to limit yourself to one question and one follow-up. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star 1 again. Thank you. I will now turn the call over to Chris Potichar, Vice President of Treasury and Investor Relations.
Good morning, everyone. Thank you for joining us for our fourth quarter and full year 2025 earnings call. Mark Bertolini, Oscar Health's Chief Executive Officer, and Scott Blackley, Oscar Health's Chief Financial Officer, will host this morning's call. This call can also be accessed through our investor relations website at ir.hioscar.com. Full details of our results and additional management commentary are available in our earnings release, which can be found on our investor relations website at ir.hioscar.com. Any remarks that Oscar makes about the future constitute forward-looking statements within the meaning of safe harbor provisions under the Private Securities Litigation Reform Act of 1995. Actual results may differ materially from those indicated by those forward-looking statements as a result of various important factors, including those discussed in our quarterly report on Form 10-Q for the period ended September 30th, 2025, filed with the Securities and Exchange Commission, and other filings with the SEC, including our annual report on Form 10-K for the period ended December 31st, 2025, to be filed with the SEC. Such forward-looking statements are based on current expectations as of today. Oscar anticipates that subsequent events and developments may cause estimates to change. While the company may elect to update these forward-looking statements at some point in the future, we specifically disclaim any obligation to do so. A reconciliation of these measures to the most directly comparable GAAP measures can be found in the fourth quarter and full year 2025 earnings press release, available on the company's investor relations website at ir.hioscar.com. We have not provided a quantitative reconciliation of estimated full year 2026 adjusted EBITDA as described on this call to GAAP net income because Oscar is unable, without making unreasonable efforts, to calculate certain reconciling items with confidence. With that, I will turn the call over to our CEO, Mark Bertolini.
Good morning. Thank you, Chris, and thank you all for joining us. Today, Oscar announced fourth quarter and full year 2025 results and the 2026 outlook. We reported total revenue of $11.7 billion, a 28% increase year over year. Our SG&A expense ratio of 17.5% improved by approximately 160 basis points over the prior year, reflecting continued efficiency gains through growth, disciplined expense management, and AI and technology advancements across the business. MLR increased 570 basis points year over year to 87.4%, and our 2025 loss from operations was $396 million, primarily due to higher market morbidity, resulting in a higher risk adjustment payable. Oscar is on track to return to profitability this year. We expect a significant year-over-year improvement of nearly $750 million in earnings from operations in 2026, representing the midpoint of our guidance. Scott will discuss our financials in more detail shortly. Before I get into our business highlights, I want to provide an update on the performance of the individual market. Overall, 2025 was a reset year for the industry. The industry-wide increase in market morbidity due to Medicaid lives entering the market and program integrity initiatives shifted market dynamics. Oscar embraced the change and positioned the company for strong top-line growth and margin expansions in 2026. We took decisive actions with a disciplined pricing, distribution, and product strategy to go after profitable growth as competitors pulled back or exited the market. Our pricing strategy always assumed the expiration of enhanced premium tax credits. Our final 2026 rates also reflected higher market morbidity, elevated trend, and the effects of program integrity initiatives. Early 2026 open enrollment results demonstrate the resilience of the individual market. The latest CMS data indicates overall market membership of 23 million lives, representing a better than expected decline of 5% year over year. We expect many passively enrolled members facing higher premiums will exit the market when the grace periods expire. We will therefore have greater clarity on final paid membership and market contraction when CMS releases final enrollment data mid-year. Current enrollment data indicates market contraction may track toward the lower end of our original projection of 20 to 30%. The individual market stability underscores the priority consumers place on maintaining health coverage. More small business owners, working Americans, and gig workers are entering the market as group insurance fails to meet their affordability needs. The individual market's fundamental characteristics, combined with a larger and growing addressable market, can absorb morbidity changes without dramatic trend impacts. Oscar is in a strong position to continue leading the individual market and defining the future of consumer-centered healthcare for all Americans. Now I will review our business highlights. The 2026 open enrollment period was a record for the company. Oscar delivered another year of above-market growth. And we are privileged to serve 3.4 million members as of February 1st, 2026. We expect to start the second quarter with approximately 3 million paid members, a 58% increase year over year. Member retention remains solid across the book, driven by our suite of affordable products, agentic AI features, and a superior member experience. Oscar's market share across our footprint increased from 17% in 2025 to 30% in 2026. We continue to grow IFP and ICHRA membership in prominent service areas, including new and existing markets in Arizona, Florida, New Jersey, and Texas. The team created new cost-effective bronze and gold plans to support consumers losing enhanced premium tax credits and expanded broker partnerships by 60% to manage distribution across the overall market. Our integrated strategy, which we deployed well ahead of enhanced premium tax credit expiration, positioned us to profitably capture new membership in the active shopping season. Product innovation was a key growth driver of this open enrollment. We launched several new lifestyle offerings tailored to certain conditions and stages of life. These include Hello Meno, the first menopause plan in the ACA, Buena Salud, our Spanish-first experience for members with diabetes, and Hy-Vee Health with Oscar, our landmark ICHRA plan. Our lifestyle products are attracting new consumer segments and creating a loyal customer base. Members enrolled in our lifestyle products have above average retention rates and are 50% more likely to recommend Oscar to family and friends. They are also more likely to come in as direct enrollments, demonstrating the greater attachment to our brand. Our deep understanding of the consumer and the strength of our product experience continue to create powerful entry points for consumers, positioning us for long-term IFP and ICHRA growth. Oscar investments in AI are creating efficiencies across the business as we grow. We lowered administrative costs by 160 basis points year over year while significantly increasing membership. AI is integrated across the Oscar platform, enabling teams to automate routine tasks, efficiently scale our service operations, and improve decision support. For example, our agentic AI bot for care guides reduced response times by 67% during peak and open enrollment period. AI is also central to our member experience. Oswell, our industry-first health agent, now completes 86% of questions received from members with high accuracy and quality. We continue to embed Oswell across our product portfolio to help members take control of their health. The impact of AI on our efficiency and the quality of the interactions for our members is unparalleled in its pace in my 40 years in this industry. In summary, Oscar's disciplined pricing, record high membership, and top-line growth lay a strong foundation for this year. We are well positioned to significantly expand margins and return to profitability in 2026. Our strategic priorities position Oscar to shape the next evolution of the individual market in the following ways. First, accelerate national IFP and ICHRA expansion. Second, create lifestyle products with an exceptional consumer experience. And third, drive operational excellence through AI and frictionless execution. The individual market is the engine of consumer-driven healthcare. When consumers choose how and where to spend their money, they exploit inefficiencies and improve the quality of the interaction. We see in our own growth the power of designing products around consumer needs. That's the promise of the individual market, the promise of choice, the promise of long-term innovation our country needs to turn healthcare into a market that fits real lives and creates meaningful coverage for life. I want to thank our Oscar team for their dedication to our customers and for delivering a successful open enrollment. Our 12 years of experience in the individual market will drive results for 2026 and beyond. I will now turn the call over to Scott. Scott?
Thank you, Mark, and good morning, everyone. 2025 was a challenging year for ACA carriers as market morbidity stepped up across the industry. We experienced these industry-wide trends with higher than expected claims and lower than expected risk adjustment offset, leading to a net loss of $443 million in 2025. Over the course of 2025, we took appropriate steps to position Oscar to deliver strong earnings in 2026, including disciplined pricing and cost management actions. I'll begin with a brief overview of fourth quarter results, review of our full year performance, and then discuss our outlook for 2026. Starting with the fourth quarter, we ended the year with approximately 2 million members, an increase of 22% year-over-year. Membership growth was driven by solid retention, above market growth during open enrollment, and continued SEP member additions. The fourth quarter medical loss ratio was 95.4%, an increase of 730 basis points year-over-year. During the quarter, we received an updated risk adjustment report for claims through October. The report indicated that overall market morbidity remained stable from the third quarter to the fourth quarter. However, relative to our expectations, Oscar's membership skewed healthier than the broader market, which required an increase of our risk adjustment accrual of $275 million in the fourth quarter. The fourth quarter risk adjustment true-up was partially offset by $99 million of favorable in-year development and $36 million of favorable prior period development, primarily related to claims run out from the prior year. Overall utilization in the quarter was modestly above our expectations. Inpatient utilization continued to moderate, while outpatient and professional increased, which we believe was associated with members accelerating care as the enhanced premium tax credits expired. Pharmacy utilization was largely in line with our expectations. Turning to the full year, total revenue increased 28% year-over-year to $11.7 billion, driven by membership growth, partially offset by an increase in the net risk adjustment payable. The full year medical loss ratio was 87.4%, an increase of 570 basis points year-over-year. Risk adjustment was a headwind throughout 2025, driven by higher market morbidity, which we primarily attribute to the full year impact of members entering the ACA market as a result of Medicaid redeterminations, as well as program integrity efforts. Risk transfer as a percentage of direct premiums was approximately 18.5% for 2025, representing a 390 basis point increase year-over-year. Switching to administrative costs, we continued to drive improvements in our SG&A expense ratio. The full year SG&A expense ratio improved by approximately 160 basis points year-over-year to 17.5%. The year-over-year improvement was driven by fixed cost leverage, lower exchange fee rates, and disciplined cost management, including an increased impact from technology and AI initiatives. The loss from operations for the full year was approximately $396 million, a change of $454 million year-over-year, driven primarily by the higher risk adjustment payable. The adjusted EBITDA loss for the full year was approximately $280 million, a change of $479 million year-over-year. Turning to 2026. We have been preparing for the expiration of the enhanced premium tax credits for some time and took deliberate actions in 2025 to position the business for profitable growth and improve financial performance. We introduced innovative and affordable plan designs aligned with member needs, optimized our distribution strategy, and took a measured approach to geographic expansion. Our disciplined pricing assumed an expected market contraction at the high end of our previously communicated 20%-30% range, driven by the expiration of enhanced premium tax credits and CMS program integrity initiatives. We also refiled rates in states covering approximately 99% of our membership to reflect the higher market morbidity in 2025. Together, these actions position us to profitably drive share growth. For 2026, we expect total revenues to be in the range of $18.7 billion-$19 billion, an increase of 61% year-over-year at the midpoint, driven by another year of above-market growth during open enrollment, solid retention, and rate increases. While our weighted average rate increase for 2026 was approximately 28%, the increase on a per member per month basis is lower, reflecting shifts in member age and metal mix. Our outlook also reflects elevated churn this year, driven primarily by passively enrolled members facing higher premiums following the sunset of the enhanced premium tax credit and ongoing CMS program integrity initiatives. From a member profile perspective, our average member is 38 years old, approximately 1 year younger year over year. As expected, we saw migration from silver plans to bronze and gold plans, reflecting plan designs intended to offer affordable options following the expiration of the enhanced premium tax credits. For 2026, we expect risk adjustment as a percentage of direct premiums to be approximately 20% based on our updated membership mix and 2025 risk adjustment experience. Turning to medical costs, we expect our medical loss ratio to be in the range of 82.4% to 83.4%, representing 450 basis points of year-over-year improvement at the midpoint. Our outlook reflects elevated market morbidity observed in 2025, an incremental increase in morbidity in 2026, and medical cost trends and utilization patterns largely consistent with our 2025 experience. We also incorporated additional third-party data to assess the risk profile of new members, which is tracking modestly better than our pricing and expectations, while renewal risk scores are in line with our expectations. With respect to seasonality, we expect MLR to be lowest in the first quarter and highest in the fourth quarter as members meet their annual deductibles. On administrative expenses, we expect continued improvement in our SG&A expense ratio. We expect the SG&A expense ratio to be in the range of 15.8% to 16.3%, representing an approximately 140 basis point year-over-year improvement at the midpoint. We continue to see the benefits of scale as fixed cost leverage and variable expense efficiencies driven by technology and AI are expected to drive further improvement in our SG&A expense ratio. We expect our SG&A expense ratio to be fairly consistent in the first 3 quarters, with an uptick in the fourth quarter. We expect meaningfully improved financial performance and a return to profitability in 2026. We expect earnings from operations to be in the range of $250 million to $450 million, a significant improvement of nearly $750 million year over year, implying an operating margin of approximately 1.9% at the midpoint. Adjusted EBITDA is expected to be approximately $115 million higher than earnings from operations. Shifting to the balance sheet, we have taken opportunistic steps to strengthen our capital position and optimize our capital structure. As a reminder, during the third quarter, we increased our capital in preparation for 2026 growth, completing a $410 million convertible notes offering due 2030, generating $360 million of net proceeds. Subsequent to that transaction, we entered into a new $475 million 3-year revolving credit facility. The transaction was well supported by a strong syndicate of top-tier banks and executed on favorable terms, further strengthening our balance sheet and providing additional flexibility as we execute on our strategic plans. We ended the year with approximately $5.5 billion of cash and investments, including $414 million at the parent. As of December 31st, 2025, our insurance subsidiaries had approximately $1 billion of capital in surplus, including $315 million of excess capital. To help frame our capital position in the context of our growth outlook, I want to spend a moment on regulatory capital requirements. While individual states vary, a useful rule of thumb is that for every $1 billion of premiums, we are required to hold approximately $50 million of capital, which reflects roughly 55% quota share reinsurance ceding percentage for 2026. Overall, our capital position remains very strong. In closing, 2025 marked a shift in the individual market dynamics. Oscar has been in the ACA since its inception, and today we are operating from a position of scale and experience. That perspective has informed the actions we've taken to position our business for profitable growth in a rational market and improved financial performance. We are well positioned to return to meaningful profitability this year. With that, I'll turn the call back over to Mark for his closing remarks.
Oscar is stronger than ever. Our decisive actions in 2025 position us to take a significant leap forward on profitability in 2026. We primed Oscar for the market of the future. The team introduced new affordable consumer products. We increased broker distribution with new tools, data, and training to efficiently move new and existing members to Oscar plans. We drove strong retention, showcasing brand loyalty and followership. 2026 is the springboard for Oscar to accelerate financial performance toward our long-term targets. Our playbook drives repeatable value in the market with ongoing product innovation, geographic expansion, and membership growth. We are not here by accident. Our growth is the culmination of years spent navigating the market and obsessing about the consumer experience. We proved consumers vote where they find value. Oscar's growth is not just about retaining our book of business. It's about staying ahead of the consumer, driving long-term individual market growth, and setting a new standard for healthcare. Now I will turn the call over to the operator for the Q&A portion of our call.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number one on your telephone keypad. Again, we do ask you to limit yourself to one question and one follow-up.
Bro, she came in
Your
hot.
first question comes from the line of Josh Raskin with
Yeah, she did.
Hi, good morning. Good morning. I guess the obvious question is how you get comfort on this new membership coming in for 2026 and, why you think the MLRs will be down so much. And then I guess related to that, maybe, Scott, if you could provide a little bit more color on your assumptions around risk adjustment. I heard the 20% accrual, but, as you become a larger part of the market, I think you said 30% market share overall. Does that actually help? Does that reduce your overall accruals? So I know there's a bunch in there.
Yeah, Josh, thanks for the question. Can you just restate the second half of your question? I want to make sure I get that right.
Just more color on the assumptions around your risk adjustment in 2026. And my point being, if you're 30% of the market, does that make your risk accruals more market rate, right? Meaning, are you going to see less volatility as you become a larger part of the market?
Yep, understood. All right. Well, let's start off with kind of the membership and our ability to project what we see there. So I would kind of bifurcate the membership between, we've got a significant portion of our membership are renewing members. We have a lot of information about those members and, feel like we can project what their behaviors are going to look like. And then we also have a population that is, new members for Oscar. We obviously picked up shares, so we do have a lot of new members. One of the things that we've increasingly done is to leverage third-party data to pull in clinical information about those members. That really is giving us, a fairly rich amount of information about those members in terms of their, historical utilization trends. It also helps us to target our outreach to, help them manage their care journey. So, we feel like we've got better insights into this oncoming membership than we've had, really at any point in our history. So, those are kind of the building blocks in terms of, why we're comfortable with the MLR projections. On risk adjustment in 26, I would say that you can see from my talking points that we're actually expecting our risk adjustment as a percentage of direct revenues to increase year over year from 25 to 26 to about 20% in 2026. It's an interesting thing that, we're starting to see a little bit of a barbell between, the plans who really cater to the highest morbidity populations and the plans that have everyone else. We're picking up, a very large share of young, healthy members. And so that's driving risk adjustment higher. We are continuing to look at ways to get more information about what is going on outside of our books, because that's the hardest part of forecasting risk adjustment. We've been engaged with Wakely on helping around this new reporting that they're, proposing to bring forward in the first quarter. We're expecting that'll give the entire market more visibility into what's going on with membership. That should help all of us in forecasting risk adjustment. And so, I don't know that it's going to decrease the challenges in making that estimate as accurate as it can be, but it certainly will give us a head start.
All right, perfect. Thanks.
Your next question comes from Jessica Tassan with Piper Sandler. Please go ahead.
Hi, thanks for taking the question. So I appreciate the color on membership. Can you elaborate maybe a little on the fourth quarter utilization pull forward you described? You guys spoke about higher retention. So should we think about the pull forward as being kind of silver members in 25 who are disinclined to utilize care in 26 due to higher deductibles? Just any color on 4Q utilization and how it relates to your 2026 utilization expectations?
Yep. Thanks for the question, Jess. Good morning. So I want to emphasize utilization was modestly higher than our expectation in the quarter. Really, when I look at the MLR performance in the quarter, I really would say that it is vastly driven by the risk adjustment true up. In terms of the utilization pressure, we did see, we had a modest expectation of an increase as we went into the end of the year, members losing their subsidies likely to go ahead and seek care. We saw that. We think that was, primary driver of some of the movement we saw in outpatient and professional. We also saw things like substance abuse disorder that ticked up, some mental health benefits that ticked up, and labs types of things. So really things that would indicate to us these were members that were just trying to make sure that they took advantage of the benefits while they had them. Don't give us a lot of concern about carry forward impact of those types of activities.
Got it. And then just, I know you all mentioned that overall market-wide membership could come in a little bit better than the 20 to 30% disenrollment you had been forecasting last year. Can you just maybe offer any color on the overall size of the market post-effectuation? And then secondarily, just any comments on kind of the adequacy of pricing market-wide? So how should we get comfortable with the fact that, all of the peers have been also priced appropriately and that risk adjustment doesn't end up being a problem in 26, same way it was in 25? Thank you.
Thank you, Jessica. From the standpoint of effectuation versus actual enrollment, we believe that the market currently has shrunk by 5%. However, a lot of people have changed their plan designs, and it was purposeful on our part to give brokers specific transitions that they could do for their members to impact the loss of enhanced premium tax credits. And so as a result, in our book, we saw silver drop in half as a percentage of what it was before, and bronze increased by almost 50%, and gold almost quadruple. And that's the kind of shift we saw in our membership mix. That means people are carrying higher deductible health plans. And this is the big open question mark for the rest of the year. Two things. One, when we get closer to paids, and our paids are on par with where they've been the last couple of years anyway, the next question is how many people, when they see their premium, actually pay it. And that's the first piece that will get us to the end of the year. And that's where we go from 3.4 million lives as we currently stand in February to 3 million lives by the time April 1st rolls around. The next big question is, I think this is as big a political issue as any other thing around enhanced premium tax credits, is as people start to use their plans and realize the amount of out-of-pocket that they need to pay to use those plans, will they maintain coverage or will they drop out? And this is where the big passive enrollment, you don't know how they're going to behave until they start using the plans. It's going to create a lot of financial hardship for most Americans who only have $400 in their bank account. And this is where we have an open question. And we think by the end of the year that number drops to the lower end of our range, which was 20% to 30% reduction of the overall market size.
Your next question comes through Andrew Mock with Barclays. Please go ahead.
Hi, this is Tiffany Yuan on for Andrew. Can you share where OEP membership landed for the book and give us a sense of where paid rates are tracking in January 26 versus January 2025?
Our OEP ended with 3.4 million lives enrolled. We have not seen all the paids yet, but our current paids are sitting close to where they were last year, and a little lower than they were in 23 and 24 on the Oscar book.
And as a reminder, we expect that as of the end of the first quarter, we'll have 3 million paid members. That's what our expectation is for that time period.
Okay, got it. That's helpful. Can you provide a bit more color around expected membership cadence following the 1Q grace period and how we should think about that throughout the year?
Sure. So in terms of churn expectations, through the first quarter, we're obviously going to see higher churn as we see the effects of the higher payment rates, or premiums that Mark just talked about. And so we'll see, a dip from 3.4 down to 3 million by our estimate by the end of the first quarter. From there, we're expecting churn patterns to look more similar to what we saw pre-ARPA. So in the range of 1% to 2% a month in terms of kind of churn from the end of the first quarter through the end of the year. The other thing I'd just point out is the other factor impacting the churn rates is that we are expecting to see less SEP membership this year than what we've seen in recent years, as some of the things like the continuous enrollment for people below the FPL 150 level. Now that that's expired, we would expect to see less of that membership. So while in recent years we've seen our overall membership trending up throughout the year, we would expect this year to kind of revert to more pre-ARPA trajectories where you see membership decrease throughout the year.
Thank you.
Your next question comes from the line of Jonathan Young with UBS. Please go ahead.
Hey, thanks for taking a question. Can you just talk about your mix of metal tiers? It sounds like bronze and gold went up significantly and silver went down. And I assume you're skewing a little bit more towards bronze, which typically has had more variability. How would you characterize your historical experience with bronze and how you're thinking about this time around?
Yeah, I would say, it's going to be interesting. Everything that you might think about metals, we should probably discard, because we've seen a transition from people who've historically been in silver to other metal mixes. So I don't think you're going to be able to, really proxy history. Bronze in general, for us has always been a high performing, product. So the fact that we've seen more growth in bronze, than in silver, and we've seen that transition is actually, something that we are completely comfortable with. If I just kind of pull up for a second, talk about the metals. Overall, our general philosophy is that our plans need to have margins that are in a relatively tight band. We would expect that all of them generate, strong contribution towards total company profitability. I do think that with the momentum, with the movement from silver to bronze and gold, we will see those plans look and act actually more similar to each other. Obviously, bronze has higher deductibles, so we may see, a bit higher churn in that population than we may see in other populations that don't have those higher deductibles. As Mark talked about, we think that may be a driver over time of more churn.
Great. And then just going back to the membership gains, if I think of that 400,000 that's going to roll off by 2Q, I assume those are the passive renewals. So that would imply a little less than half your membership is quote unquote new. I guess, are those new members coming in from new markets that you had entered into? And I know you have data, you're using third-party data to get a better sense of the members, but I guess how much has things changed, from last year to what it may look like this year, where maybe that third-party data may not be as accurate? Thanks.
I'll let Scott talk about the third-party data, but let me just sort of dimension this for you. Your calculation is pretty close. That 400,000 is going to be passive. That will roll off. We have grown a bit. And what we did early in the summer is we went out and enrolled 11,000 new brokers. We met with 17,000 brokers over the summer and gave them lists of members that they had with us, and showed them the members that were most affected by the lack of enhanced premium tax credit and what plans you could move them to based on their needs. They went and did that, and we gave them access through our broker portal to our campaign builder software, which we used to outreach to members to reach those people and give them the information before open enrollment. And that's why we got off to a fairly significant start early on, because the brokers had it all stacked up, ready to go. Our view was the more we can help the brokers get people to the right place, the more they can be productive elsewhere, which is then what happened, is that they went to other plans who either were leaving the market or had not prepared the broker community or the membership with the right kind of product changes, and moved those members as well. So that's sort of the lay of the land on how our growth occurred. We weren't sure how it was going to roll out for new membership, but it obviously had a significant impact.
Yeah, and Jonathan, with respect to the third-party data, I would say that for new initiations, most of those people, we've got clinical information from third parties that gives us, a good basis to have an expectation how they're going to perform. And, importantly, it gives us, a lot of information about who we need to start to engage to help them manage their healthcare conditions. That's important both from the perspective of managing our costs as well as, getting the member in as early as we can, which is a positive thing for risk adjustment as well. There are a portion of our new initiations who are new to the market, who we don't, have great information about, but we do have a significant amount of data over time as to what those types of people might look like in terms of their acuity. And, we've, in looking at kind of the information that we do have about those members, we're not seeing anything in terms of the characteristics of them that causes us, to think that there's something there that should be concerning for us.
Your next question comes from the line of John Ransom with Raymond James. Please go ahead.
Hey, good morning. So if we take 3 million as kind of the quote unquote real member number, approximately what % of those do you think worked with a broker and tried to tailor the coverage versus the remaining passive renewals? I think that'd be helpful. Thanks.
We generally see 95% of our members come through the brokers, although in some of our custom plans, like Hello Mano, we saw a lot of direct enrollment, significant direct enrollment, people specifically wanting that product and came directly through us through the exchanges. So, but generally, and we're looking at 95%.
And then this is kind of a basic question, so you all can downgrade your opinion of my IQ, but what I don't understand is I get the passive enrollment, but you've got to pay the first premium before you get coverage. So what kind of member gets passively renewed, pays the first premium, and then decides to drop off?
Again, that's the big question this year versus prior years. Usually when they start paying premium, they stay with us, unless there's some sort of event where they don't require our coverage anymore. However, in this case, when they start looking at the out-of-pocket costs associated with plans that they were moved to or stayed in, they're going to start to say, wait a minute, this is expensive, and I'm not going to be able to afford this. Now, what we see, and this is an important aspect, it's far different than prior years in this marketplace, is that most Americans now see healthcare as their single largest line item in their homes, in their family budget, more than their own mortgage. The result is that they are afraid of, a lot of people who buy from us are afraid of losing the house or losing their family or having to go bankrupt if they don't get coverage. So then the real question, the pivot question that we have, and I met with the AHA board of directors a couple of weeks ago, is what happens when they can't pay the deductible? And how do we handle that? And that's where we're sort of looking at this milieu and saying, does it create disenrollment? Do people still hold on to it because they're afraid of losing their homes or going into bankruptcy? We're not sure. So we're hedging our bets on the level of disenrollment that'll occur as a result.
John, just to add one more dimension there, when you look at our expectation and what we're seeing on payment rates, if you're going from having an out-of-pocket premium that you were paying in 2025 to having an out-of-pocket premium that you're paying to 26, and you have actively enrolled and even passively enrolled, we're seeing relatively strong payment rates in those categories. It's really the population where you're going from a $0 plan to something that you've got to pay out of pocket so you've either lost your subsidy or you've transitioned from one plan to another. That's where we expect to see really high non-payment rates. And the way the whole process works, you may not make your first payment in January, but you don't ultimately turn off until the end of the quarter because you are in a grace period until then.
I see. So passive going from zero premium to some premium. And we know that like call centers, in some cases, we're used to signing these people up and never had a payment link. But our understanding was Oscar wasn't a big user of these legacy call centers. So you've got payment links. It's just that they go from say $0 to $100 a month, and that's just a bridge too far. Is that right?
You are correct. We are not a big user of call centers.
Okay, thank you.
Your next question comes from the line of Stephen Baxter with Wells Fargo. Please go ahead.
Yeah, hi, thanks. I wanted to come back to some of the questions on mix. I appreciate you're saying that silver's lower and both gold and bronze are much higher, but is it possible to get maybe the percentages kind of before and after for each category? And basically the crux of it is that obviously your membership PMPMs seem like they're going to be up somewhere in the 50% range. So we're kind of comparing that to the overall revenue increase on the guidance line, and it's a little bit hard for us to square quite why there's not maybe more of a PMPM yield in there. So it'd be great to have some more quantification of that, and then have a follow-up if there's time.
Sure. So for bronze, for the prior 2 years, around 25%. In 26, it's 39%. Silver has been steady at 71% the prior 2 years. This year, they're at 36. And gold, which is in the low single digits, 3-4% for the last 2 years, is now 25%. So fairly significant changes. And the bronze and the gold plans we offered were $0 with, fairly not very rich benefits.
Stephen, the other thing I would just mention is that the characteristics of the membership are important to modeling your revenue. So the fact that we're seeing a year younger membership has an impact on PMPM revenue. So you need to factor that in. That's one of the reasons why I discussed that in the call, is to help with your ability to project revenue with that information.
Got it. No, that's helpful. And then maybe just qualitatively, like, is there any difference in terms of this MLR guide, how you're thinking about kind of what you're budgeting in for retained membership, and sort of how you're thinking about this newer to the plan membership and how that might perform? Like, would love to understand just philosophically how you're thinking about that part of it. Thanks.
Yeah, well, we obviously model membership with a lot of our past history. So, we will have experiences that are different for returning members versus new initiations. I would say that in the aggregate, given the amount of work we've been doing on this population going, which is now over 2 years that we've been expecting that these subsidies are going to go away. And so starting with the whole, how do we design plans to capture people who've had a price shock? We've really built in, I think, a deep level of expectation and understanding about how those different populations are going to perform. I talked about all the ways that we tried to triangulate and get data about those folks. But I think that in general, I would say we're using our historical experience with each of those populations to project the future. Feel like that the estimates that we've made both in pricing and now, we've taken everything that we've heard, to date and built that into our guidance. And, I feel like we're being very balanced in our estimates.
And the increase in risk adjustment allowed also takes the MLR up.
Your next question comes from the line of Scott Fidel with Goldman Sachs. Please go ahead.
Hi, this is Sam Becker on for Scott Fidel. I was just curious on what are your key levers to achieving EBITDA profitability without the extension of the enhanced subsidies, and what are those key headwinds or tailwinds when thinking about MLR and SG&A from 2025 to 2026?
Well, there are a number of them. First, it's growth. It's, growth drives a reduction in overall percentage of costs. AI, where we're able to create a better member experience and greater stickiness, and we're seeing that on a regular basis. We have dozens of LLMs on the back end of the business, and now 2 agentic AIs, and we're about to launch another here in the next few months. So we're now having a lot of impact where people can access us quicker with much more accuracy and without having to wait on phones, which also again reduces our costs. And then on the MLR front, we are constantly working on our contracts and our utilization management, and we task the team to deliver so many 100 basis points every year and opportunities to keep our trend in line with where we think the market should be. And so all of those things together, and there are a lot of levers that we manage every day through the management process, are the things that we track to make sure that we can hit our targets.
And Sam, I just want to make one point really clear. Our guidance is on EBIT, so it's not on adjusted EBITDA. I did talk about it in the call that we would expect adjusted EBITDA to be $115 million above our earnings from operations guidance that we put out. So I just want to make sure that we're talking, about the same things. Thank you.
Your next question comes from the line of Michael Hall with Baird. Please go ahead.
Good morning. This is Olivia on for Michael. Thank you for taking the question. Because exchange marketplace risk adjustment is net neutral, creating a reliance on other plans in your market, the lack of visibility any one plan has into the rest of the market makes risk adjustment mechanics difficult in our view. Looking to 2026 and beyond, you mentioned the potential Wakely industry report in 1Q. Whether it's through this potential Wakely report or other efforts, can you share how you're getting more insight into the rest of the market, as well as your thoughts on what can be done to make risk adjustment more transparent and less volatile in the future? Is there any potential reform you think could be done to improve risk adjustment? And I have a follow-up if there's time.
Olivia, thanks for the question. Look, I think that estimating risk adjustment, as you say, is the most difficult thing that we have to do each quarter, because you're both trying to project your own performance inside your own book and also the market. I think we're quite good at projecting our own market, our own book and what the performance is. Where we do get surprised is by how the market moves in ways that we can't see. I'm optimistic that working with Wakely, and it sounds like most of us in the industry are working with them as an important service provider to all of us, to help get more timely information about what's going on with the market, because that's the most challenging part of our ability to project that. So, I think we're taking steps in that direction. I'm not sure that we'll get all the way there in this first report, but I do think that with the support of many of the industry players, that we can, increase visibility into this estimate over time.
Thank you. And if I can squeeze in,
Go ahead.
if I can squeeze in one more, please. When I think about healthcare innovation, 2 specific areas I see Oscar leading the way in becoming an agent of change are in ICHRA, that could disrupt an employer group market that is ripe for change, and leading the charge in crafting condition and disease specific plans, which appear to be the future of health insurance. Both are exciting, but both are early on. So as you look ahead, what do you think needs to happen to catalyze the rate of adoption? And as a first mover, what type of competitive advantages do you believe this will present Oscar longer term?
So from an ICHRA standpoint, Olivia, we are not only concentrating on products to capture membership in the insurance company, but we've also built out the front end of the business where we can now work with employers to convert them. There's a lot of opportunity in revenue and actually in higher margin, unregulated and not requiring any risk capital, to work with employers to move employees into defined contribution. And once in defined contribution, work with brokers to get them into whatever plan works for them, whether that is an Oscar plan or not. So you're going to start seeing us over time report 2 different kinds of revenue in the model, where we're going to have revenue coming out of the conversion of employers to the defined contribution, the whole brokerage work that's done there, and then also membership that we capture inside our own health plan. So the ICHRA opportunity is much larger than just the membership, although our membership did double this year. And given what happened in the individual market relative to rates, there was some reluctance on employers to jump in now. We need to show that we can stabilize that marketplace and get more people in. So that's sort of the lay of the land on ICHRA. On the disease or the lifestyle products, we truly believe, and this is the proposal that we put in front of the administration and one they've talked about, is to separate the investment decision from the financing decision. The investment being what I buy versus how I pay for it. And the opportunity to create HSA, Roth IRA-like funds where people can take whatever funding mechanism they have, whether that's their employer, their own money, Medicare, Medicaid, or other subsidies like from the ACA, and put them into a bucket. And by buying a qualified health plan, manage the rest of their costs by themselves, and this is where our new agentic AI tool is headed, then having a marketplace where people can use the money that they receive for healthcare to buy what they want in their local market and their own network with a plan design that changes with their life, starts to create the opportunity for lifetime value of membership and changes the investment thesis that insurance companies would have in managing that membership and how we would approach it, which leads to the lifestyle products. If we can move with a family or an individual through their lifetime, offering them new designs that allow them to stay with their network, be effective in managing their current health status, and live as fully as they can till their last day, I think that's the ultimate culmination of an individual market where all Americans can get healthcare that they want, their choice, and where we have a market so large that morbidity changes really have no impact on the overall underwriting cycle of the business.
Your next question comes from the line of Raj Kumar with Stephens. Please go ahead.
Hi, maybe just following up on the kind of ICHRA commentary. Just curious on the membership associated with the Hy-Vee arrangement and kind of what's the initial uptake from that employee base. And then, historically, have you seen kind of the ICHRA population exhibit a more kind of stickier membership base, or should we expect a similar level of churn relative to the kind of broader individual plan?
I think first of all, we're not giving out actual ICHRA numbers by segment yet. It's not meaningful enough to move the dial, although we see all of these efforts being successful so far. The more important part is, again, back to this thesis of I have my money, I buy it the way I want. We think ICHRA is stickier because as long as I have the funds to pay for it, I can keep what I bought. And I don't have to change it. If my funding circumstances change, I just use the different funding to keep the same thing I had. So we view ICHRA as a development moving beyond the ACA model, which is helping people when they can't afford health insurance, to a model where I now buy my own insurance, my own network, the product design that fits me at this time, and allows me to stay with my product and my network for as long as I want. That's where the member experience and all these tools we're building comes in, where people can actually use it the way they need to and have the information they need to use it most effectively.
Got it. And then as a quick follow-up, just kind of curious on the new member engagement rates for 2026 and how's that comparing to what you're seeing or experiencing at this same point last year?
Yeah, I don't think that
too early to tell, really. Yeah. After the first quarter, we'll have a better idea.
Your next question comes from the line of Craig Jones with Bank of America. Please go ahead.
Great, thank you. So I was wondering what you've assumed in your guidance does the change in the percentage of zero utilizers between 2025 and 2026. I think that would need to come down. The expiration of enhanced tax credits. If you can't give us the exact percentage, maybe just how do you think that'll compare to your 2019 percentage prior to when those were enacted?
Yeah, correct. Thanks for the question. Excuse me. In general, we don't comment on the portion of our book that's non-utilizers. It's a normal part of, given that we have a very healthy membership, we would anticipate that not all of those members need care in any given year. So we do have a portion of the book that doesn't utilize. When I look at how our book is evolved, our book is younger than it was a year ago. So, it isn't necessarily the case that you should assume that we'll see, lower levels of non-utilization. We take all of those factors into account when we set our guidance for MLR. And as I talked about earlier, we've done a terrific amount of work to build up our estimates around, those projections, and we feel like we're as comfortable as we can be with them at this point in the year.
Okay, got it. Thank you. And then maybe for those 400,000 members that expect to roll off by the end of the quarter, what do you think their 2025 MLR was, and how would that compare to, say, historically, what your members that rolled off would be? Thank you.
Yeah, I'm not going to dimension the specifics of those members. When I look at the difference between 2025 MLR and 2026 MLR, it's really a story about the changes in market morbidity on a year-over-year basis. That's really the biggest driver. We've taken into our pricing for the upcoming year all the changes that happened in market morbidity last year, our expected increases as people are leaving the ACA in 26. We build all of those things in. We've included a trend that is higher than what we've seen in the historically, but relatively consistent with last year. So we feel like we've taken all of those building blocks that's going to impact utilization next year into our pricing, which gives us confidence about our ability to return to profitability next year.
There are no further questions at this time. Ladies and gentlemen, that concludes today's call. Thank you all for joining. You may now disconnect.
All right.
That was a lot.
That was a ton.
Dude.
There's a lot to unpack there.
I have like a page worth of notes.
Yeah, first and foremost, stock is down. Stock is only up 2% now. Nope, it just jumped up 3%. So I'm just going to address the main thing why the stock probably is not flying right now is mainly probably because 3.4 million members is what they're reporting, and they're being, and this should tell you a lot about the company though. Like, they could sit there and just say 3.4 million members and then not say anything else until next quarter. But they're sitting there telling you straight up, hey, we're at 3.4 million members. We fully expect 400,000 of those members to fully drop off this first quarter from churn.
Yep.
Why? Basically because we expect them to not become paid members. So they're telling you, even at 3 million members, though, this is the funny thing. I was running the numbers. Even at 3 million members, that is going to be 43% quarter-over-quarter growth in membership count and 79% year-over-year membership growth. So it's like one of those things like, hey, here's 3.4 million. Oh my God, that's crazy. We're going to lose 400,000 of that. Oh my gosh, you guys suck. Even though it's still 70-some% year over year, 47% quarter over. Come on, man.
What I will say, especially in this market, so there's a few things, most specifically on member count, that I thought was very interesting. So let's take a look at the broader market. A lot of these companies, First and Teen, UNH, is seeing large double-digit drops in members. Year over year, we're contemplating and I guess more so not really arguing, but kind of going back and forth on whether or not Oscar is going to grow significant double-digit or super significant double-digit. We're not talking about, oh, we're dropping members year over year. Are we going to be growing revenue? Based on these numbers, it is almost flat out guaranteed that we're going to see at least like a 40% increase in members. Like at bare minimum, based on the expectations that they're putting out there, probably 2.8 million bare minimum. And this is assuming that it's slightly worse than the already 400,000 decrease in members. So when we're looking at this also, one thing important, that there was a few good questions, especially at the end. We're talking about ICRA. ICRA is expected to be a lot more stickier, because how ICRA works is your employer is giving you money, so you're going to spend it no matter what, pretty much. And you just have to worry about more so the difference. So when it comes to that, there is a higher likelihood that if you're being given money, you're going to buy something no matter what, even if it's a bronze plan or a lower plan. And it just really, at this point, where we are, especially going to the forward in the future, when you have UNH, Molina, Centene, etc., they're losing members and Oscar is gaining members. The fact that we're gaining at all, that is very strong.
All right, Jeremy Hustler is he is clearly an expert in the ICRA markets, and he said they're not a leader and it's not going to work. It's not going to work in the ICRA markets. Well, no one said they were a leader. They didn't say they were a leader. They didn't even report any of the numbers for ICRA, and they got asked directly on the call about ICRA numbers, and they said they're too small to even talk about. But we're seeing good growth and we're seeing things work out there. So like, it's not even something really we should even discuss. Like, let them prove it. Okay, if you don't think it's going to work out, that's fine. I don't really care. Like, to be totally honest, if it works out, great. If it doesn't, okay. They just showed you they grew members an insane amount in the ACA markets. This is what makes me like, this is what annoys me about investing and like stocks and just talking to people. Can we just like cut out all the bullshit? And can we just talk about, guys, this company grew memberships like crazy when everybody thought they were going to lose massive amount of members and they were going to just die. Also, they're growing and guiding for revenues that are going to be insane. Also, they're guiding for net income positive. They're guiding for 2.3% net margins, right? Do you understand? I ran the numbers on that. That puts them, for their guide, that 250 to 450 million, that puts them essentially comparing them to 2024 EPS numbers and net income, that puts them at 44 cents to 79 cents of positive EPS this year. And what did Mark Bertolini say? He said he expects what did he say? 4 or 5% margins in 2027 or by 2027.
So
Remember?
I know from the interviews he said 5%, but I'm not exactly sure.
Yeah, the interview. That's what I'm talking about. Okay.
Oh, yeah, 5.
So I ran 4%, right? And that means for 2027. So that means 2026, we're looking at between 44 cents and 79 cents of EPS, which puts them at like at these current prices, that puts them at like a 16 PE. And then for 2027, if they hit his 5% net margin or 4% net margins, not even the 5% that he said, that would put them at 77 cents to $1.37 EPS. Like, they're literally sitting there guiding for EPS positive. They grew members like crazy. Their revenue is exploding. Their SG&A costs are coming down. You just need to understand that, yeah, there's some things that they cannot control in this market with medical loss ratios, but they're doing everything that they literally need to do in order to make it work. More revenues, less losses, less SG&A costs and expenses. What do you think happens with all this revenue whenever they actually have some favorable medical loss ratios? What do you think happens? Like, guys, like, The revenue is exploding. The memberships are exploding. What do you think happens whenever they actually get favorable medical loss ratios? Something that they can't control. I mean, what else do you like? I don't understand. Like, this stock should be up 20% right now, in my opinion. I don't understand what people want more from them. All their competitors are reporting like losses in memberships, higher medical loss ratios. They're reporting Armageddon. They're reporting that they're leaving the ACA markets. And Oscar's just over here. Oh, more members. Even if they say they have 3.4 million and then they drop down to 3 million, okay. It's still a 40-some% increase. Like,
I was
am
gonna
I
say,
crazy, AC? Like, I don't even understand this, man. Like, it's
so
insane. It's insane to me.
one thing that I think was very interesting that Mark he kind of made a little bit, he made extra clear in the earnings call is, I don't know if you caught up on that or caught that, but when they were talking about the MLR specifically, they said the only reason, to a degree, they were basically saying that the only reason the MLR from an accounting standpoint is going to be higher is because of risk adjustment. I don't know if you caught on to that, but Mark kind of he kind of like said because of risk adjustment, like in between two people speaking. So that means, prior to risk adjustment, does this mean that their MLR can be, far lower? It's definitely going to be very interesting to see what ends up happening. But I don't think so right now, just based on the stock's reaction, I just think the market doesn't believe it yet. And it's going to be something
100%.
that we're just going to be kind of in a position in holding a stock that kind of, until it's proven, until we get that Q1 2026 earnings, we might not respect the guidance yet, like not really respect it, but more so believe it quite yet. And that kind of, it's definitely unfortunate because even from a, it's also earnings was just released today. Everything could change very soon. But when it comes to this, like the fact that we are gaining members and gaining them significantly, even if the number is lower than the 3 million, which by the way, I'm not trying to sound bearish, but I'm factoring in a potential bearish argument that even if the numbers were lower than 3 billion, listening to more so a bearish argument, there was around 2 million members. I believe the final number was what, 2 million members, 2,042,000.
2.12 million.
Yeah.
On September 30th, 2025, they had 2.12 million members, and now they've jumped to 3.4 million. Even if they drop all the way down to like 2.8 million, like, dude, what are we talking about? A quarter-over-quarter basis, that's insane. That's insane growth.
And I also think that within that earnings call, I can't remember if it was the CFO or Mark or who, but they specifically mentioned, like, we are not here by accident. They were anticipating the ACA subsidy expiration for 2 years now, and they have been positioning for the last 2 years for this moment. And I just think that at this point, I think a lot of legacy insurance companies, Centene, UNH, all these other companies, were just not prepared for this moment. And Oscar was prepared for this for a long time. And the fact that they even mentioned that they feel balanced on guidance with these numbers, I think that is, at this point, it's just going to have to be proven. And once it's proven, there is no reason why we should be anywhere near $13 a share.
So sometimes you just have to have a very basic thought process about this, that revenues are just exploding. Like, SG&A costs are coming down and membership growth is going higher. So when you just look at that and you understand when they get more favorable medical loss ratios on their side, which they are guiding for, which they believe is going to happen, which the mean is 80%, what are we even talking about? When that happens, Oscar immediately is re-rated to the heavens. Like, dude, like, we're re-rated to the heavens because of how much revenue, because of how many memberships they've grown, and because they're not just like going crazy on their spend. Somebody commented, they probably don't believe them even more because they reaffirmed their revenue guidance and they missed. So that's fair.
Yeah.
That's fair. They were supposed to do 3.11 billion in revenue this quarter and they did 2.75, so they missed by like 11%. I'm gonna have to dig into the numbers to see why they missed like that, but at the end of the day, somebody also was like, they said, yeah, miss numbers here and then just guide crazy numbers and, guide crazy numbers and they'll do way better, whatever. Right. So basically like a magician, like look over here and then, they missed over here. But if you know anything about Mark Bernalini, that's not his style. Like that's not his, I mean, I know I'm talking about hopes and beliefs in people, but I mean, you need to believe in a CEO if you're going to invest in the company. And to me, I believe in Mark Bertolini and their guide, I believe is probably, I don't see how they didn't they probably guided, in my opinion, less than what they actually think they're most likely going to do. Would you agree with that, AC?
Yeah, I mean, also just going to circle back. The fact that we were talking about 18.7 to 19 billion in the first place, like the mean analyst estimate in the first place, which realistically the mean and the average are very, very similar, around 12.8 billion in the first place. We're talking 6 billion higher than what we were originally talking about. And at this point, just running some super rough numbers. Now, one thing that I tend to do, which of course it doesn't translate directly, I guess, to the health insurance as much, but always paying attention to annual revenue, annual ARPU, the annual revenue per user. Now, when it comes to the members, how much is exactly being brought in? Just taking very high level, the revenue divided by the total members. Now, gets your number for the full year, just about $5,690 per plan for the entire year. And this is super high level, just a super high level analysis that I like to put together. But just taking that ARPU, multiplying it by the 3 million members, and assuming only a 15% price increase because some members have switched from, let's say, silver to a lower plan, only considering a 15% price increase, which arguably you could even go lower, put you around 19.6 billion. So just doing a very, very basic quick look at this, and I know it's not foolproof, but just looking at a basic quick look of this, these numbers do seem quite credible if this is going to happen. It just seems like at this point, first off, I must reiterate the fact that we're even talking about 19 billion. If you told me this 3 days ago that we're talking about 19 billion, I would laugh in your face and say, I don't believe you. And this is even coming from someone that is super bullish on Oscar. I was expecting 15 to 16 billion, realistically with a minimum of 14.5 billion. And we're talking about 18.7, 19 billion. This is just insane.
I can't with some of these comments, honestly. What is the risk? What is the risk that they get sued because a good chunk of their members is fraudulent?
So,
okay,
I was going to comment on something like this because so there was just a recent report that says Republican House panels issues a subpoenas 8 health insurance companies, and Oscar was included in one of this. And basically, reading through this a little bit now, I don't know the full story. I don't know exactly the full story, but apparently they took a look at 12 people, and they took a look at 12 people that supposedly never existed, but supposedly had health insurance. And now, one thing I think is important is at the very end of the earnings call, there was someone who asked a question about these call centers, and that something to do with these call centers that were very high in fraud, basically signing people up that really weren't actually getting health insurance, essentially. And it kind of seems like at this point, it's always going to be a risk, especially being in this industry and how these premium tax credits were structured. But if we're comparing Oscar to a lot of these other insurance companies, which are not gonna lie, some of these are known for fraud and not exactly being the most honest. Based on how the leadership has handled a lot of this, which, by the way, it shows that the follow-up letters were sent um, while each company had replied to the inquiry. None of them had meet the person's expectations. I personally think and personally believe that if anyone's going to be in the spotlight, it's going to be more so UNH, Centene, or CVS, Aetna. There are going to be other avenues and companies that are probably going to receive more heat for it. But at the same time, we need to think about this from a high level perspective. Are they just going to fine every single insurance company because there were people that, there were fraudulent members? And, I say this because there's always fraud in every single system. And it's just an unfortunate of how things are going, especially with an ACA marketplace where, some of these members, can have $0 premiums. When you have $0 premiums, that, opens up a whole entire avenue of potential issues inside of a situation like this. And when you have a scenario where that is a possibility, you kind of need to definitely take a look at the risks of this actually happening. But then you have to look at the overall market growth and understanding. We saw significant growth following COVID, especially since the enhanced subsidies were taking place across all companies within the health insurance industry. So there's definitely a potential risk for this, but I think the potential risk is not anywhere near the potential growth and structure and forecasted growth going into 2026 and 2027 and 2028. It just doesn't make any sense. And it just kind of seems like a similar thesis, similar to the Zeta Global lawsuit, which affects, I believe, you have more information on this, I'm sure, but I believe it's like 1% of their revenue. Like, even if we're talking about, a percentage of revenue, to think and say that a large part of Oscar's revenue, for example, and member growth and members in general are going to be fraudulent is just complete BS, in my opinion. Just looking at the high level picture, it just doesn't make sense. And to see that they are receiving, they believe, where was it? There was
If
notes.
they're fraudulent, why would they come out and be like, yeah, we're going to do 3.4. We did 3.4 billion members, but guys, we're going to lose 400,000. Why be so transparent? Like, what are we even talking about, dude? Like, it just makes no sense.
What I was about to say too is the current paids are sitting at similar levels to 2025. And this is comparing, this is coming from the earnings call, but the current paid members are currently sitting similar to 2025 levels in terms of members, and expecting roughly 3 million paid members already based on the current trends. If this is going to be kind of, a big thesis behind fraudulent members, members wouldn't be paying because, fraud's not going to be taking place on throwing money back into the company from a purchasing fake members. It's going to be taking place on these $0 premium plans, which I personally believe is a lot different in terms of risk level from Oscar compared to maybe a UNH or Centene or a lot of these other companies with a lot older audience. Because what tends to happen with fraud, especially in the healthcare industry, it tends to happen with older individuals. Oscar, I believe in their earnings call, had mentioned that their average member age dropped a year. They dropped a year. I believe I heard on the call 39 to 38, I believe, which is very young. We're comparing to these companies that probably have a lot larger audience of maybe 50, 60, 70, 80, 90, a lot older individuals that are more susceptible to fraud. If we're in an insurance industry and with an insurance company that is a lot younger individuals, they're going to know if fraud's being taken place with their name, because eventually at some point, they're going to look at their health insurance. And I'm sure, especially in the ACA marketplace, if you're double enrolled, you're going to pretty much know about that. And I just think that it's a complete flawed thesis to think Oscar's at the highest level of risk. Of course, there's always risk with everything, but I think if you're talking about, if someone genuinely believes that Oscar's on the high level, highest amount of fraud potential with a potential subpoena like this, it's just complete BS, and just there's not enough facts to back that up. And I just think it doesn't make sense, especially from a demographic perspective.
And if you look at just even like medications coming down in price due to what Trump is putting pressure on these companies, like that obviously affects the medical loss ratios as well. So bringing down costs. So I don't even, I'm at a loss of words, man. Like, I don't know. Like, believe in the company or don't. I don't really care. Like, I see revenues going up. I see memberships going up. I see them being very transparent about everything. Very transparent. Very transparent. Okay. They're getting subpoenaed along with eight other companies. Okay. Like, let's not jump to conclusions. Let's just see what happens. But dude, I trust in Mark Bertolini. I trust in this team. They're like, I don't know how much more like transparent you could be. 3.4 billion memberships. We're probably going to go down to we're probably going to lose 400,000 of those down to 3 billion paid members, blah blah blah. And then they're sitting there saying and you heard them, like somebody commented and was like, "Oh, somebody commented and said it sounds like they're being very like, cautious with their like when they're talking and answering questions." And yeah, because they don't know everything, right? Like they're sitting there saying, well, typically when someone signs up and pays their first premium, they continue to pay their premium all year and they stay with us. But like Mark was saying, the CEO, he was saying, we just don't know how people are going to react when they're paying their premium and then they break their leg and they got to go to the doctor and then they have to pay X deductible.
Yeah.
Because not just with premiums going up, right, and health insurance becoming more expensive, deductibles have to go up. Like that's just how it is. And especially they have those tiers now. So gold tier, you are paying more premium and less deductible. So it's like it's a give and take. Like the health insurance isn't going to cover all your health needs. Like that's just not what health insurance is. If you have health insurance, you know this. If you have something wrong with you, if something goes wrong, you're paying a monthly price to basically not have to pay everything when something bad happens for someone else to help you with what happened, right? So they're sitting there saying, and I don't even think I believe that. I don't know about you, AC. I think they might be being a little bit too cautious, but I'm fine with it. I think they're probably being too cautious with like, especially with being like a 38-year-old average. I think they're being too cautious. But again,
Yeah.
I'm fine with it. Them sitting there saying, and I might be babbling, them sitting there saying essentially, okay, we have these members. We expect a lot of churn because they're paying right now, but they might fall off. They might fall off and say after their first injury, after their first whatever, and they realize, oh, they're paying X premium and they have to pay X deductible. They might sit there and say, that's basically what the leadership was saying. That might be an issue for a lot of people to be able to afford it. But I think that's being too cautious because health insurance really does dominate a lot of things. I know in this household, I have a wife and two boys. Like in this household, health insurance isn't a want. It's a need. It's a necessity. Like I can't sit there and say, oh, well, it's a bit expensive. So I guess, my one oldest son, like I'm just, not going to have health insurance for him. That's not happening. Like if something happens to him and I got to pay what, $10,000 for an MRI? Come on. Like, what are we talking about here? So I think they're probably being a little bit more conservative, but again, that's fine. Be more conservative and then come out through the year and beat and show people like, hey, we're the real deal, right? I
was gonna say, I don't know about you. I'm just super stoked and excited for this next coming year, especially like to go throughout 2026. I mean, we also need to realize that our average member age went down a year. We grew members significantly by pretty much a million, pretty close to a million, over a million members. And this is, of course, pre-drop off, of course. And this is definitely something to pay attention to, is most specifically because of the MLR. Now, just for example, I did receive a comment regarding more so the MLR and the MCR, and I thought that was very important to kind of look at, and more of a bullish comment, of course, following the MCR and MLRs for 2026 guidance. Oscar, now sometimes, I just think the market just genuinely doesn't believe this guidance because it's so good. And that is just how I currently am right now, because the MLR for the 2026 full year outlook is between 82.4 to 83.4. Now, historically, January is typically very good and sets the stage for the rest of the year to kind of slowly rise, of course, with how the morbidity trends have been. But when we take a look at UNH's medical care ratio, which is very similar, they're guiding for a consolidated medical care ratio of 88.8%. We're talking pretty much a 6%, almost a 6%, from the middles, around 6% difference between UNH, for example. And I'm sure, Molina and, the rest of them, are very similar. It looks like, I believe Molina's was pretty close to UNH, around 88, 87, I believe. I don't have the number exactly off the top of my head, but we're talking about a company that has low 80s MLR in a market. We're talking about a big market, the ACA marketplace, that didn't drop as much. And when we're talking about the competitive earnings, this was kind of expected. I just didn't expect this well. And it just kind of has me a little speechless a little bit. Like, everything we paid attention to signaled higher member growth and very, very strong higher member growth. And we just pulled in, I don't even know what the heck member growth, somehow pulling in 3.4 members at the end of open enrollment and expected to be around 3 million. Like, in my most bullish, my most absolute bullish case scenario that I was thinking of did not have me anywhere near this. Like, I was more so thinking like, okay, we'll end at like maybe 2.4 million, and then with the price increases, a good fair value will put us at least like 35. And this is what I was originally thinking. And now we're just completely destroying that. 8.7 billion to 19 billion, 82.4 to 83.4 MLR, SG&A at 15.8 to 16.3, continuously decreasing year over year. Same with the MLR, both decreasing from a 2025 standpoint and reporting profitability back in 2026. If things change, and even if things change a little bit to the worse and revenue guidance isn't hit and member guidance isn't hit, we need to still realize that is a huge increase compared to 2025. And this is just trying to think of it in a more bearish segment, in a more bearish way, that let's say members aren't as strong. Members aren't that strong, let's say 2.8 even, for example. This beats everybody's expectations across the board, even with the revenue decrease. And I'm trying to be bearish on this. It's really difficult to be bearish on this when management is already factoring in a decline. And also, what we need to realize is a lot of these members are new members. Now, we definitely want to pay attention to, I believe somewhere he mentioned there was a drop in existing members, which I was talking about. Some of the existing members had dropped off, which was a good significant amount. But this is really very, very, very good, because going forward, when you're looking at the new members that are coming in, the new members are more likely to stay because they've already seen the new amounts they're going to be paying. And that's very important to think about, because if we're seeing 3.4 at the end of open enrollment and then going down to 3 million, even after a potential, short-term drop-off, I'm just mind blown. I think this earnings is going to be incredibly great, and the market is just discounting it because of the rest of these large insurance companies are unable to navigate this very, very, very competitive market. And once we get even an ounce of positive legislation from the Trump administration, I guarantee you this stock is going to just soar.
Yeah, Josh said there's uncertainty all around. Yeah.
That's what people are pricing in.
Yeah, there's uncertainty everywhere. Yep. But at the end of the day, what's not uncertain is that they're growing 3 to 3.4 million. They grew 3.4 million members, and even they're sitting there saying like You know, we could lose 400,000 of that and it's still 3 million, which is still up almost a million. So
Yeah, price projections are already scrolling around on X. What is this? CWB Research, forecasting the low and the high end. Looking
Oscar up 10% off the open.
Oscar's. Yeah, 9.4. Yeah. Price targets
Sorry,
are
my
coming
kids
in.
were over here screaming.
That's okay.
Yeah, 10.5% up now off the open. I don't know how else to put it, man. Like, I'm really trying to just say like super basic with it. Like,
dude, I'm just excited.
Yeah, I'm pumped about it. Like, I don't know how else to put it. Like, everybody can come in here and say bearish this, bearish that, uncertainty this, uncertainty that. I don't give a shit. Like, memberships just exploded. Revenues exploding. They're guiding for crazy revenues. They're guiding for like continued membership growth. Like, eventually, when you pull, like, it's like Amazon. Amazon pulls in all this revenue, right? Like, are their margins the greatest right now? No, because they're in this super growth stage. But eventually, we know Amazon margins are going to be insane. And when Amazon's margins become insane with the level of revenue they have, they're going to be printing fucking money. And look at all, I don't think Oscar's any different here. Memberships are growing at an insane clip. They are stealing market share from the big dogs because they're a disruptor. Their stock price is almost at liquidation value based on their cash, their free cash flow that they're pulling in, and their mark compared to their market cap. Like, believe it, don't believe it, I don't know. I don't know. And it's another thing, like, can we talk about how stupid this is? Like, they sat there and they said, okay, actually, we're not going to do, what was it? They were supposed to do like sub 11 billion this year in revenue. And then they guided up to like 12 billion. And then they still did like 11.7 billion.
Yep.
Okay. They were a little bit off. But they still did more revenue than what they were going to do. They still raised guidance. They still beat. Like, apples to oranges, guys. Shit. Like, I think people are being way too hard on a $3 billion market cap company that's growing this insane and stealing market share and disrupting like this.
What I was going to say is it's a little bit harder to, I guess, forecast on a quarterly basis because of the MLR guidance as well, from the MLR variable. So on a quarterly basis, it's definitely up in the air as if they're going to beat or not. But from an annual perspective, they very consistently, at least to my knowledge, very consistently just beat and raise on an annual basis. And that's really what matters, especially going into this year. I just think that there is just no way that we don't perform strong, especially going into the end of 2026. I mean, I'm seeing people run valuations left and right now on X, looking at minimum like 39 share at a 20 PE, 19 billion, 16.3% on the high end.
So I was running while we were on the earnings call. I was over here on valuesnapshot.io. And I was running an EPS model here, right? I ran an EPS model. And again, guys, these are analyst targets. We're currently at, now off the open, we're at like $14, I think, $13.89, right? Analysts on a low have a $13, a $16 consensus, and $18 high. I would only assume after this big surprise and beat that these all go higher. Okay. But let's say they don't. Let's just go and be very conservative. I told you, based on the 250 million operating net margin or not net operating income, 49-cent EPS. This is the EPS on the low end, right? I told you can go up to 77 cents. This is the EPS on the low end. So if we start out here and we go 3 years out, so if we start out here and then go 50% EPS growth rate at a target PE multiple of 15 at the end of this 3 years, okay? This means that 49 cents, I told you that if they grow from 49 cents, 250 million, and then they get to 4% margins in 2027, like Mark Bertolini said, that gets them to like 77 cents of EPS. And again, they could do 77 cents EPS this year if they hit the high. If they hit the high of this guide at 450 mil, guess what? Guess what? They're doing 77 cents this year, not next year. So just taking the conservative, the low end of their guide, 49 cents, then going to 74 cents, 110, and then 165 in EPS with a 15 target multiple, you're looking at 47% undervalued right now. You're looking at a fair value of $18.60, which I still think is very low. And this is being conservative because, like I said, let's say they do the 77 cents and then it starts getting crazy. Then you're looking at a $30 stock today. And again, they guided for 250 to 450, and they guided with these medical loss ratios. With these medical loss ratios, I think they do way better than this, honestly. I think they're just trying to be very, very conservative and walk on eggshells because this year is going to be crazy. And look at that. Somebody knows. Somebody knows because reminder, we were at $11 at 6 a.m. $11 at 6 a.m. We dropped
Ridiculous.
10%, like AC said. And then we jumped a 10%. And then we just went down to like 2%. And now we're up 13% off the open.
Yeah. Dude.
Guys, this is a bombshell. No one gives a shit about what they did and didn't do this quarter. They care about this. This guide, nobody was expecting this guide. AC at his bolus, Ronnie at his bolus. We're not expecting this guide. Like, at all.
Ironically, not even close.
Not even close. Like, dude, like, this is a bombshell. Like, if we're not up 20% by the end of the day, like I said, I'd be very surprised. Like, this is just, like, I don't even know how to explain it. Like, everybody can say bearish this, bearish that. I mean, whatever. I don't know how you're bearish on this. Like, this is a $3 billion market cap pulling in like $19 billion in revenue. Okay, margins are small in health insurance industry. Okay, well, guess what? Even if they get 2% of those margins, they're still pulling in 49 cents of EPS, which puts them with current price at like a 15, 16 PE. Growing what? Growing, let me see. I did the chart. Growing membership count, 62% quarter over quarter, 103% year over year. If you take down to the 3 million, then they still grew 43% quarter over quarter, 79% year over year. And the revenues are basically almost doubling. Don't even get me started on free cash flow, because free cash flow is insane. Because their free cash flow, guys, is stupid. So if we expect, right? So if we look at trailing 12 month, look at their free cash flow. Their free cash flow was around like 10 to 11%, even up to 12% here on a trailing 12 month basis. If we expect them to do that 250 to 450 million and kind of do better than what they were doing in 2024 on margins, then their free cash flow is probably going to be somewhere like 13, 14%. Can you hear my dogs?
Tiny bit.
Okay. Not too much?
No. It's like super tiny bit.
All right. So let's say they're howling.
Oh, a little bit more now, but it's not bad.
You take over until they shut up.
Yeah. I mean, just to kind of look at some of these comments, dude, all over X, like everybody's now bullish on Oscar again. Ironically, you know, this was just a complete bombshell earnings. Like nobody was expecting this, and quite frankly, the most bullish of the bullish. Like my most bullish estimates were like 17.5. Dogs like the price action. Yeah. 17.5. Like this is completely unreal. Like we were not expecting quite frankly, anything like this, I think the analysts were asking great questions at the end, by the way, you know, but you know, at the end of the day, we need to go back to the as of December 31st, 2025, 2,042,449 members. And at the end of the open enrollment period, estimating at the end of open enrollment period, roughly 3.4 million in members. Now, they're even being conservative and expecting a pretty decent drop off all the way down to 3 million. Now, let's say we do get that 3 million. That's over a 10% drop compared to 3.4, just over a 10% drop. Sounds good. Just over a 10% drop in membership alone that they're already factoring in. Not to mention revenue. We're looking at over 18 billion in revenue. Meanwhile, in the prior year, for the full year ended 2025 at 11.7 billion. Now, what was the original guidance for 2025? It was around 11 billion. So all around the board, it was absolutely completely crushed. Yeah, exactly. You know, it's right now, I think the biggest fear is just not expecting that to be hit. But also when it comes to that, especially, you know, coming to Oscar, is that people were worried that we weren't even going to grow membership. And we're growing membership very, very, very drastically. And I just don't think that people are really taking into that to account. And I just think that it's just getting way, way, way too cheap. And all I got to say is I'm very, very glad that I have a ton of leaps for 2026. And if you are on X right now and you are paying attention to a lot of feed that's going on right now, there is a lot going on, a lot of price predictions, just analyzing the financials. Like everything across the board is very, very strong. And I just think that at this point, you know, once this gets proven, just imagine, just from a price to sales perspective, which, by the way, a price to sale ratio is a perfectly good way to analyze Oscar. Just very, very simple ratio that's calculated. And, you know, just comparing it to a lot of industry competitors, you know, especially during the hot time, the hot point of the insurance industry, you had UNH and a lot of their competitors, you know, they were trading at 1 times plus. Like I think UNH was even trading at 1.5, 1.7 times, for example. And for a company growing at Oscar's rate, you know, we could justify having a higher price to sale ratio like that. And really at this point, you know, either the market's going to like it, it's going to continue going up, or at this point, it's just going to stay stagnant. Oscar needs to prove it, which, by the way, Oscar having to prove anything near what they're guiding for, I just think is ridiculous. You know, we are expecting such a good, strong 2026. I see nothing happening at this point. If it only gets to 15 billion in revenue, which would be a massive miss, the company would be trading at 0.22 price of sales anyways. Don't even get me started. Like, in my opinion, we are so damn undervalued. It's just not even close. I've continued to just nonstop every single time I get paid, just buy Oscar, buy Oscar, buy Oscar, buy Oscar. Every single time. Definitely not financial advice, but it's all I have done for the past few months. And going into 2026, I have no doubt in my mind that if even this, first off, even if you question the credibility of this guidance, even if you question the credibility of this guidance, if this gets achieved in any way, shape, or form, even close, plus or minus, even $1 billion, there's no reason why this stock should be trading anywhere near what we are at. And once these analyst price targets come in, and once analysts start analyzing this data, they're going to be like, we were so wrong. We put the same assumption on that we put Molina, same assumption we put Humana, same assumption we put on UNH, and they're going to realize that they were so far off. It's not even funny. It's just ridiculous that we are at anywhere near the valuation we are today when we just completely blew out the park with where we are at the moment.
Yeah, markets are down and crypto's down big and Oscar's holding like 9 point some percent. But I do have to end the stream. My my kids and my wife and mother-in-law were about to leave. They're going to the fire museum. So I was gonna sit here and do more, but you know, it's my birthday. I'm gonna go spend time with my family. Great Oscar earnings. Couldn't have asked for anything better. I appreciate you joining me, AC. We'll definitely have to do this for earnings going forward for sure. You've been a great help, and appreciate you, man. Hope everybody has a great day, and go Oscar. And yeah, I'm just gonna go step away and be with my kids and everything. So I appreciate it, guys. Hope you have a
too,
great
man.
day. See you
Happy
later,
birthday,
AC.
dude.
Thanks, man.
Have a good day, man. See you, everyone.